Hi, everyone. I'm Amanda Lang, anchor for BNN Bloomberg, Bloomberg's partner in Canada. On behalf of Bloomberg, we're very pleased to welcome you to the second day of the Bloomberg Canadian Fixed Income Conference. As you may know, the Canadian Fixed Income Conference is now in its 9th year. It's a unique event. It brings together the biggest names in Canadian bonds, credit, commodities, and more, including policymakers. You can check out the event agenda at bloomberglive.com for all of the information on today's sessions. We're going to take a deep dive into the Canadian economy and into financial markets from the perspective of various players, including those in the mining, real estate, energy, insurance, and asset management industries. Leading financial executives are going to tell us how they see the current landscape and also some of the opportunities and challenges that lie ahead. We have a segment today devoted to discussing the ways in which the country is transitioning to a cleaner economy, more sustainable. And we're going to hear from a variety of experts on the various approaches being taken towards ESG. And in addition to the industry and expert-driven panels, we look forward to keynote interviews. We have Eric Martel, CEO of Bombardier, Alexandre Leroux, President and CEO of WSP Global, Pierre-Carl Pelado, President and CEO of Quebecor, and Kathy Barswick, Chairperson, Sustainable Finance Action Council of Canada. Quite the lineup. First, though, I'd like to thank our sponsor, National Bank of Canada, for helping make this virtual event possible for everybody. Before we get started, just a few housekeeping announcements to ensure that we all enjoy the day. If you experience any issues with your audio or your video, you can refresh your browser or use the chat box in the bottom right-hand corner of your screen, and you can ask for support. You can engage with us on social using the hashtag BloombergCFI. It now gives me great pleasure to welcome Martine Hébert, General Delegate in New York from the Government of Quebec.
Thank you, Amanda, for the warm welcome. I am very delighted to be here today. Thank you, Bloomberg, of course, and the National Bank of Canada. You have both been true partners of the Quebec office in New York and the Quebec government for many years, and we thank you for that. Year after year, the Bloomberg Canadian Fixed Income Conference touches on timely and relevant issues. Today, we will hear experts from sectors such as real estate, energy, mining, finance, and media who will share with us their fresh perspectives on their economic sector. No two nations depend more on each other for their mutual prosperity and security than the US and Canada. Quebec's international trade was more than $130 billion US in 2020, of which more than a half is with the United States. New York State is one of the province's biggest American trading partners, taking in more than $6 billion US annually. To put this into perspective, we trade as much with New York as we do with Australia, Brazil, and the UK all combined together. Our economies are so integrated and our critical supply chains so tightly linked that any given product can cross the border several times before it gets to the market. Simply put, we depend on each other, we prosper together, and we compete together on the global stage. In addition, Canada is the leading and most reliable supplier of renewable energy to the US. And the two have a highly integrated energy system that provides an affordable, green, and secure source of electricity. As many of you might know, Quebec's utility, Hydro-Quebec, is North America's largest producer of renewable energy and has been providing electricity to the US for over 100 years. And this strong partnership keeps expanding. In fact, just last week, Governor Hochul announced two major green energy infrastructure projects to power New York City. One of them is the Champlain Hudson Power Express project, developed by a US company named Transmission Developers Incorporated in partnership with Hydro-Quebec. The carbon emissions reduction resulting from this project will be equivalent to removing approximately 44% of the cars from New York City streets. This is another great example of Quebec's contribution to our common decarbonization objectives. With a growing cluster of innovative companies and interconnected ecosystems in sectors such as renewable, clean transportation, and green technology, Quebec companies are well positioned to offer innovative solutions. You will hear from some of them this morning, such as Boralex and Lion Electric. As we have heard on this stage earlier, it is in the interest of all of us to continue building our economies together as we recover from COVID. So let's continue to partner, to innovate, and to find solutions that will build a greener, sustainable, and more prosperous economy for North America. I look really forward to hearing more insights from the distinguished speakers today. Thank you very much.
All right. Hello, everyone out there. Welcome to the real estate panel of Bloomberg's Canadian Fixed Income Conference. My name is Ari Altstetter. I'm a reporter who covers Canadian real estate out of Toronto. And we're really, really lucky today to have two quite senior people from Canada's real estate industry with us for our panelists. We have Cecilia Williams, who's the Chief Financial Officer of Allied REIT. Hello, Cecilia. And Tamara Lawson, who's the Chief Financial Officer of QuadReal. Hello, Tamara. And without any ado, because we don't have enough time and we have tons of meaty topics to get into, I'm just going to launch right into it. And we'll talk about what's on everyone's mind, at least everyone who works in an office and is figuring out what to do next. And that's the return to office and the potential end from work from home. Now, over the last over the summertime, let's say over the summertime, there's a lot of talk that Labor Day would be the point at which there'll be a stampede back to the offices and everything will get back to the way it was before. And the indicators that we've had from around the world really have been fairly mixed on that. And in fact, even if you've been going to the office, I just came back from Toronto's financial district just now, and it doesn't look too full. So I'm starting to wonder, well, what's going on? And let's go to our panelists and find out what you guys are seeing on the ground, what you're hearing from your tenants, what you're seeing in your properties around Canada and around the world. Cecilia, maybe we'll start with you if you don't mind.
Sure, absolutely. So we only operate in Canada, so I can speak only to our Canadian experience. And certainly Vancouver has been ahead of the curve in terms of physical repopulation of office or of workspace from the start. They did I think a much better job of managing their numbers. And so they were always much more repopulated than our Toronto or Montreal offices. I would say that right now, roughly 50% of our office space in Vancouver is repopulated. Calgary has been a bit more variable recently because of the unfortunate, rise in their numbers and hospitalization rate. They were trending higher, in that 30 to 50% range before this most recent situation. So hopefully, their numbers stabilize and improve and they can get back to that. Toronto and Montreal have been the slowest in our experience to repopulate. Actually, I walked down to the core yesterday and I was actually pleasantly surprised because I hadn't seen as many people at the corner of University and Front. I hadn't seen that many people in the last year and a half, but you're right. I think psychologically, everyone was thinking the week after Labor Day, school will be back, there will be more people. And I think we have seen that repopulation happen, but not in as meaningful of numbers as we originally expected. From our user base, everyone's saying that they intend to bring their people back. We haven't had anyone say we're going to a 50% working from office, working from home model. I think different companies in different industries are trying to manage the safety of their employees. I think the most recent mandate from the government for people to get vaccinated has helped. I think maybe whatever the day after Labor Day was, any of those start dates were maybe pushed to October 1. But we're certainly seeing more people in our buildings in both Toronto and Montreal. So I would say Toronto and Montreal in our portfolio are about 25% repopulated right now, and that number expected to increase from now to the end of the year.
And Cecilia, just to jump in there, to follow up for our viewers, my understanding is that Allied's tenant base, there's a lot of tech companies in that. Do you think that plays into that sort of sectoral composition, plays into the fact that what you're hearing is that a lot of people will be back to full occupancy eventually?
I think the tech companies, again, just from our experience, they want their people back together. I mean, they're the ones that invented this fantastic technology that we're using to even have this discussion right now virtually. But I think they realize, like others in other industries, that people are ultimately more productive and happier when they're together with their teammates, with their peers. And I mean, there is a bit of what I've noticed from my friends and some of my colleagues is there's a little bit more of a burnout situation happening when there isn't a commute and there is no distinction between home life and work life. And I think people want to have a place to go to work and then to leave to be with their families and with their friends in a separate physical environment. So I think this extended period of being outside of the office has perhaps, maybe I'm romanticizing it, I don't think I am, but I think it has perhaps actually made people maybe yearn for those days of going back to the office. And maybe it won't be 5 days a week. It wasn't even really 5 days a week before the pandemic. That flexibility might be more easily afforded with complete reopening. But I think ultimately people do want to be with their peers.
Okay, and Tamara, I want to turn the question to you because, QuadReal, you have a very large portfolio and it's all over the world across a number of different sectors. So I'm really curious to hear what intel you're getting from that network.
Okay, sure. Well, first of all, starting off, and I would say very similar to Allied in terms of our Canadian portfolio. We are seeing people come back. Since Labor Day, we have seen people come back, not to the extent we were anticipating maybe a few months ago, but it is increasing. Around the globe, we're seeing, we had our offices in Hong Kong were back early on in the pandemic because they had things quite under control. We saw our New York offices back in the springtime, sometime in the springtime, and they've been there, I would say, pretty steadily ever since then. The London office is back now. It was a little slower to go back, so it's a bit different by region. But I think if you look at the Avison Young Vitality Index, which is really a global index, and it really is about workplace traffic, it's across the board seeing increases. It's significant. The traffic is still below, obviously pre-COVID levels, but we are seeing across, the globe increases. There's a few spots where that might not be the case. Australia, for example, and, maybe in other areas. And, as Cecilia mentioned, Calgary for us, people are working from home just in the last few weeks, but they had been in the office on a regular basis prior to that. So it's quite interesting. I also agree with Cecilia in terms of people wanting to come back to the office. And, I think research really does show that there's a lot of activities that are better suited to the office workplace. And, I think people also want that human connectivity as well. So, I think people want to come back. We've also seen a little bit of what Cecilia was talking about in terms of burnout and, just maybe a slowdown in productivity versus what happened initially coming right out of the pandemic. People were highly productive and everything was new and there was a lot of things that they needed to deal with. But I think as it's dragged on, burnout and productivity are becoming more of an issue. So, I think we'd like to get people back, and I think, on a bit of a hybrid model, I don't think people are going to want to give up the flexibility that they've enjoyed now over, the last year and a half. So I think that's, beneficial in terms of employees and their, satisfaction overall. But I think, our staff really, wants to get back.
So just to follow up on that, in terms of what you're hearing from your tenants on where they see things shaking out, do you see, are they saying, okay, we're going to be back 100%, or are they saying, oh, we're going to be back 3 days a week, 2 days a week, and we're going to need to cut our use of space? Have there been any projections or anything you're hearing from tenants on what they intend?
No, I mean, they haven't. I mean, I think everybody's saying that they won't be back. I don't think anyone thinks they'll be back in an office setting. At our properties, it's totally different. They're back. They've always, they've never left. But in the office setting, I don't think it's going to be 100. I don't think anyone's talking about 100%. But I'm hearing everything from 3 days a week to 4 days a week. That seems to be the most common. And we haven't heard a lot of people giving up space because I think they're also feeling like they don't want to densify the way they were pre-pandemic, and I think they want space, more like social space and more connection space and sort of collaboration and interaction space. So I think we're hearing that people are looking at how to redesign things, but at this point, not necessarily hearing that people will be giving up a lot of space.
Interesting. And in terms of investment, of where your companies are planning to invest, CBRE had a report about the second quarter, saw a record investment in commercial real estate for the quarter. The floodgates were open. It was really an industrial leading the way, multifamily a close second. Surprisingly, even retail didn't do that bad. It was about in line with its 3-year average. Office was the one sort of laggard, the notable laggard, well below its 3-year average in that quarter. So I'm just curious about where your companies are planning to invest going forward, the sectoral makeup, the geographic makeup, however you want to take that. Cecilia, I know that typically Allied has been a very office-focused company. I don't know if you're planning to diversify into other asset classes or change some geographic composition. However you want to take it, what investment changes are you making going forward coming out of this pandemic?
We will not be making any investment changes, and we have actually been able to take advantage of some opportunities that came up because of the pandemic. There were some private owners that had held real estate in their families for decades, and all of a sudden the pandemic hit and they realized, oh wait, these real estate investments are not a risk-free proposition. And so we were actually able to complete about 100 million of these small infill acquisitions last year and 100 million in the first half of this year, along some other larger acquisitions. And those don't seem like they amount to big dollar items, but they will represent incredibly strategic opportunities in the future for intensification and continuing consolidation in Canada's urban centers. So we continue to very much want to grow in Canada's urban cities, and we will look at whatever opportunities come up. We don't intend to change our operating or investing focus. We will still very much be focused on distinctive urban workspace across Canada.
Okay, Tamara, any planned changes to report in your investment makeup?
I mean, not really any changes because of COVID per se, but changes just because of the evolution of real estate and certain trends that have been happening there. But I mean, we are very focused globally. 80% of the investable universe is global for real estate. So we have been primarily focused on growing globally. And we are very focused on industrial and multifamily. That those are two of our key conviction areas. But we're also, looking at alternatives, and we're really seeing, in terms of real estate, an increase in investment into alternatives and things like student housing, land lease. We're investing in also life sciences is another area that we're focused on. And data centers as well is another area that's been a high growth area. So yeah, I mean, we're looking at both development as well as, I mean, primarily development, going into sort of build to core is really kind of our focus that we're looking at there.
And will the forthcoming investments, I mean, will you continue to buy office assets or build office assets, or will it be more looking towards these alternative asset classes in terms of where you're allocating capital?
Well, I mean, I think it'll be mixed. We'll also be, in terms of development, I should just clarify, I mean, we're looking at sort of mixed use development with a focus on the residential side of things. And in those mixed use developments, they're primarily along transit lines. We will look at some office as part of a mixed use development, but unlikely standalone office without other residential components.
Interesting. That brings us to a topic that I'm really curious about. You bring up mixed use. Malls. People have been wondering what will happen to America's malls for a while now, and the pandemic has not helped. And a lot of mall owners, their planned solutions to turn these into mixed use developments by adding both office and residential to these properties, making sort of little neighborhoods. I'd be curious to hear each of your thoughts on this as a viable option. I mean, Cecilia, as an operator of office property, is this the kind of project you want to be a part of? Would you be involved in the redevelopment of a mall, adding an office component?
I don't think we'd ever rule anything out, hypothetically anyway. I'm not sure what the opportunities would be in Canada's cities to redevelop malls into office space, but I like to think that we would consider anything. I'm not sure if that's more of an opportunity outside of the city centers, which we don't play in that space, but maybe it's an opportunity for others.
And Tamara, your reaction to that?
Yeah, I mean, we're definitely, we're looking at, as I mentioned, I mean, we have a large development that we're working on currently right now, Oak Ridge Mall in Vancouver, which is very well located mall and has a lot of residential and sort of high-end residential areas around it. So, I mean, our interest there is that we're densifying with additional residential, and there's a bit of office going in there. Primarily, we're focused on the residential densification side of things. So, definitely that. I mean, that's what we're looking at in terms of retail. I mean, the retail is really changing a lot, as you know, and the demand is really pivoting to like prime destinations and convenience are sort of the two main areas of focus in terms of retail. But retail as an industry is doing well. It's a big part. It's a huge market. Both in terms of all retail makes up a huge portion of our GDP. So we think there are opportunities. But it's major urban centers. We really aren't focused on anything other than major urban centers. We're not focused on strip malls or any of the retail that have had issues. So it's really a mixed use transit densification opportunity that we feel is going to be the best area to focus in on.
Very interesting. Well, I guess I'd like to take this time then to thank you both. We're rapidly winding down the clock right now, so I'll have to leave it there, despite the fact there really is plenty more to talk about. I wish we had another 20 minutes, a whole another panel's worth to keep this discussion going. But thank you both for making the time. It was a really good talk, and let's do it again soon. I'd really like to.
Hello, my name is Robert Tuttle. I'm an energy reporter based in Calgary. Alberta, and today I'll be speaking with Lars Glemser, VP and CFO of Vermilion Energy, and Rodney Gray, CFO of Baytex Energy. So I'm going to let both of you describe your company, but let me just start by saying that today Brent oil is near $80 a barrel, and you think back just over a year ago, the world looked like oil was negative, and it seemed as though the world energy demand had maybe peaked and was perhaps not going to reach what it did at pre-pandemic levels. And yet here we are today, high oil prices. We have extremely high gas prices in Europe and Asia, and filling stations in the UK that are running dry due to a shortage of truck drivers. But so in this situation, we seem to be in an energy crunch. So I'd like to just start by asking. I'll start with you, Lars. I mean, your company is very global. How are you navigating this situation currently? Just tell me a little bit about your company and how you're navigating the current situation.
Great. Thanks, Robert. And thank you to Bloomberg for hosting us today. And you put it well, Robert, what a difference a year makes. Certainly a lot different backdrop than it was in 2020. And, I think from Vermilion's perspective, we've been around 27 years. And for 24 of those 27 years, we've had an international presence within our portfolio. So we do like to think that we take a bit of that longer term view on the business to navigate some of the peaks and valleys that are inevitable in our industry. And we think that is one of the attributes that we offer to investors is we are geographically and commodity diversified, which I think provides a lot of risk reducing attributes, whether you're on the debt or the equity side of the investment. To put that into perspective, you look at European gas pricing right now, strip for 2022 is in excess of $20 an MMBTU in Canadian dollar terms. So we think that is one of the attributes that we bring to the table. I think in terms of how we're navigating the current environment, we've had a strong focus on generating free cash flow for the last number of years. Previously, it was all going to fund the dividend in terms of a equity-friendly return to capital policy. I think with some hindsight, we let our simple payout ratio get a little bit too high in terms of to that 40 to 50% range. And the other sort of observation was in 2020, our debt levels were too high and it made for an uncomfortable year. So we have been very focused over the last 18 months on debt reduction. To put that into perspective, we are looking to generate in excess of $400 million of free cash flow here in 2021. From an equity standpoint, that's about $2.50 a share. However, here in the short term, that is all going towards debt reduction. We exited 2020 at 4 times debt to cash flow. We're now forecasting to exit 2021 2 times or less debt to cash flow. And then we think that there's line of sight to achieving our longer term target of 1.5 times or less at some point in 2022. So, I think here in the short term, we'll have a continued focus on debt reduction. As we look at 2022 and start to plan that year, we will have a lot larger focus on return to capital and a potential return to paying a dividend. We've been quite vocal with our investors, debt and equity side. We do want to return to a dividend paying model or return to capital strategy. What 2021 has done is accelerate those type of discussions. So I'll leave it there, Robert.
Thank you very much. Rob, tell us a little bit about your company and how you guys are navigating the current environment.
Sure. Thanks, Robert. And thanks for having me join you and Lars today. Appreciate the opportunity to share some perspectives on Baytex and the industry. By way of background, Baytex is a North American energy company that's operated for over 25 years, very similar to Vermilion. We do have our production that's basically just in North America. So we produce about 80,000 barrels a day. 60% of that would come from our Canadian operations, which is located in the provinces of Alberta and Saskatchewan, and 40% would come from our production that's located in the Eagle Ford position in South Texas. We do trade on the Toronto Stock Exchange with a market cap of about 1.8 billion, an enterprise value that's closer to 3.4 billion. Obviously, those numbers are pretty dynamic as of late, but they are moving around. And we do have 2 public debt deals outstanding right now, one that matures in 2024 and a second that matures in 2027. So maybe more specifically to recent events and how we're managing the business, we originally set our plans for 2021 based on a $40 to $45 WTI price environment. Our plan had us investing $250 to $275 million and generating approximately $150 million of free cash flow. Since then, we've seen a significant improvement in commodity prices. And with the increased prices, we did a couple things that were unique at the time and were announced with our first quarter results. So one, we announced a 5-year plan that outlined our priorities and demonstrated our free cash flow generating capability of our assets. And 2, we revised our capital spending plans modestly higher for 21, increasing by a little over 10% to approximately $300 million at the current midpoint of guidance. And this really sets us up for the planned period. But also now we're forecasting to generate over $350 million of free cash flow. So when we look at our planned priorities, disciplined capital allocation, maximizing free cash flow, improving our leverage ratios, and enhancing shareholder returns. So very similar to what Lars has laid out for Vermilion. We've laid out what we think is a very disciplined 5-year plan that sees our production remaining stable in the 80 to 85,000 barrel a day range, investing less than 70% of our funds flow with annual capital spending of about $400 million. And with that, we see ourselves generating over $1 billion in cumulative free cash flow through 2025 out of US $55 WTI price environment. This grows to over $2 billion at 65. And obviously with prices today, that's significantly higher. So with that free cash flow comes several options, as you'd suggest. First of all, I'd say our number one priority is to further strengthen our balance sheet, which is where all of our free cash flow in 2021 is being directed. We're targeting a net debt to EBITDA ratio that's around 1.5 times in a $55 environment. And so for us, that means debt of, call it $1 billion to $1.2 billion. And at current prices, we'd expect to hit that $1.2 billion level, probably by the first half of 2022 now. As we hit our debt targets, I think we'll be in a much stronger position to consider enhanced shareholder returns, and that could come in the form of share buybacks, dividends, or organic growth opportunities. At our current valuation today, we'd probably be leaning towards more to share buybacks, but we'll see where we get as we approach our debt targets. The other update that's new and exciting for us at Baytex is our emerging Clearwater play in the Peace River region, an area where we've amassed 80 sections of land in partnership with the Peavine Métis settlement. We've drilled 5 wells on the lands to date, and our production's gone from 0 to just over 2,300 barrels a day. This is an asset that we think has among the strongest economics in the industry today, and most importantly, at current pricing, can actually grow within its own cash flow. So to put this into perspective, at $60 WTI, we see IRRs of over 300% and payouts of under half, payouts in less than half a year. At current pricing, these wells pay out in 2 to 3 months. So they're exceptionally profitable. So this is an asset that fits very well within our business model, and we believe it enhances the overall plan that we've got and put forward. So we haven't built this into our 5-year plan. So we feel as we continue to delineate our lands, this will only strengthen our overall business. So as you can probably tell, I'm pretty excited about where we're at today, and I could talk for a while, but maybe I'll stop there for now.
Thank you very much. I mean, one common theme you sort of both talk about is being disciplined, returning, paying down debt, returning capital, returning cash to shareholders. And yet, we're looking at, a real crunch in energy. We have these extremely high prices. So your companies aren't terribly different from a lot of other companies that are trying to be very disciplined. But when do you see, this real high prices reaching such a level that you are going to reinvest it in drilling more and capital in capital budgets. Let's start with you, Lars. Well, how about you guys? I mean, you guys are in Europe, so you've got a real exposure to the gas prices there.
Yeah, no, good question. And, similar to Raw at Baytex, we started 2021 with a $300 million capital budget, and we were quite transparent that we were not spending to our sustaining level of CapEx. So we were letting production decline. Our sustaining CapEx is probably more in the $375 million range. What we'll start to do here for 2022 is get more line of sight around what we're going to do operationally. So, for example, we are likely to drill 2 wells in Australia in 2022. That'll add about $50 million to that sustaining CapEx number. So we are getting more comfortable with a little bit more investment into the asset base. At the same time, though, we're targeting about 84,000 barrels a day of production here in 2021. That low to mid 80 number is a production number that we'll be targeting for 2022 as well. So that won't be changing. We'll have about 50% investment into our international business, 50% into North America. And, I think what we are really hearing from the capital markets is in the near term here, the industry needs to repair its reputation from a profitability perspective. And as a result, growth is not only going to not be rewarded, but it may be punished as well. And my view is that over the next couple of years, there will be certain companies that potentially earn the right to grow in terms of showing investors that there is profitability within the industry and within certain companies. And I think that is where our focus is going to be as well in terms of spend to sustain current production levels, and then look at what the appropriate uses of free cash flow beyond that. And, I'd say one of the items that we are open to is M&A as well, in terms of where does that compete with potentially returning capital. So that'd be the Vermilion view here in the medium term.
Yeah, thank you. Rod, you said you did boost your capital budget a little bit earlier in the year. I think. What is your outlook? I mean, what's going to motivate you guys to really ramp up drilling and production?
I think Lars touched on it. I think in general, you're going to see continued capital discipline in the industry. Message has been pretty clear from investors: maintain capital discipline, drive free cash flow, and look to provide returns to shareholders. I think over time, this should improve investor sentiment for our industry, which is positive for everyone. But I also think it's going to be, it could vary slightly company by company. For Baytex specifically, we're laser focused on maintaining capital discipline and striving to maximize our free cash flow. But having said that, I just talked about the emerging play located in the Peavine Métis settlement that's not included in our 5-year plan, but in current prices can grow within its own cash flow and has the potential to generate significant upside for our business. So you could see a modest increase to our capital, but we're talking very little there in terms of overall impact to the capital program.
Well, thank you. Lars, you spoke a little bit about the mergers and acquisitions. We've seen so much activity, especially here in Canada recently. We had the Inter-Pipeline deal on the midstream side, but we've also seen some upstream players as well doing deals. Where do you guys do you see opportunities for acquisitions or anything on that scale, Lars?
Yeah, no, and I did reference that, and I think if you look through the history of Vermilion, we've been a good acquirers of assets. I think the best acquisitions we've made have been where we have an operational presence already. For us, that's a pretty broad landscape in terms of Australia, Europe, and North America. We will continue to evaluate opportunities. I think first and foremost, our preference is to do M&A in Europe. We think that we truly bring a competitive advantage to Europe, less competition as well, which benefits the buyer opposed to the seller. The issue with Europe is there's a little bit less deal liquidity, so we do have to be patient from that perspective. Now, you referenced some of the bigger deals that have occurred here in North America, whether it's Canada, US, upstream, midstream. I'd say we're less interested in that merger of equal type acquisition activity. We're more interested in creating more scale where we already have an operational presence, and looking at synergies just in terms of what we can bring versus the previous operator. And hopefully we have some time to touch on it, but those synergies would include on the ESG side as well, which we think is important. So we'll continue to evaluate. And if we can make an acquisition deleveraging as well and accelerate the debt reduction targets as well, we'd look to be opportunistic there.
Thank you. How about you, Rod? What do you say?
Similar to Lars at Vermilion, I think we're always looking for assets in and around our operating areas. So if there's tuck-in acquisitions that we're able to look at, we're always evaluating those. I think we're very focused on making sure the asset quality is there, though. So how do the assets actually compete against our current portfolio? We'd characterize our current core assets as having 10 years worth of development inventory on each of those assets. And so when we look at M&A opportunities, we've got to make sure that they're actually accretive to the existing portfolio. Otherwise, you're delaying them for several years and the actual profitability just isn't there. So we're very focused on asset quality, given that we've got a set plan here and looking to make sure it's accretive, but always looking for opportunities more in and around our areas. And Lars touched on it as well. I'd say we have a bit of a different lens to some of the M&A opportunities out there. And that lens is really the ESG lens, and see how it's going to impact our overall operations go forward, whether it be GHG emission intensity or water usage, or just in terms of where the operations are located. So maybe I'll leave it there.
Thank you. Just real quick, you both sort of, Lars, maybe I can touch a little more on that ESG theme. Where do you, what is your outlook on that? Do you think that the industry can sort of overcome this, the image it has these days of among a lot of investors being shunned because of that? How do you guys approach that?
Yeah, so both Rod and I have touched on the importance of ESG in terms of capital allocation decisions. And, similar to, we take a lot of pride in putting out production and capital guidance, meeting it, as well as our debt reduction targets. No different on the ESG side of it. So we've got a commitment to 2050 net zero. I think more importantly, we have shorter term commitments in terms of GHG reductions around scope 1 by 2025. We want to reduce by 15 to 20% from 2019 levels. And that is now a target that we have out there, and we are openly talking about it. I think it's interesting in terms of, again, both Rod and I touched around skepticism within the industry from a profitability perspective. There's also that ESG skepticism of the industry. And I'm fairly, positive, I guess, over the longer term that I think capital will start to recognize that there are responsible producers of energy, and we're going to be doing the right thing from a E perspective in terms of the ESG theme. And then I think, what capital market providers need to do is make sure that we are also delivering on the social aspect of ESG, making energy affordable to consumers as well over the longer term. And I think there will be a recognition that these traditional energy producers like Vermilion and Baytex, they deserve investment to make sure that we deliver on all three components of the ESG discussion. So that's where Vermilion is at.
Thank you, Rod. Any more perspective you can put on that?
I think Lars touched on it. I'd say overall, we've probably done, as an industry, we've done a poor job of demonstrating a lot of the good things that we've done in terms of regulations that we operate within and changes that we've made to our overall operations. But at Baytex specifically, I think we've been reporting on these initiatives for well over a decade, but we've definitely seen them change over the last years. Almost exponentially. And there's all these different reporting frameworks and things and gathering the information. And I think the industry itself is almost in a stage where they're gathering a whole bunch of information. We're trying to standardize some of that information and reporting. And then eventually, I think you'll probably see some external attestation of that information. And I think that'll go a long ways to improving the overall a reputation and probably differentiating companies quite significantly in this area, because there's certain companies that are taking it very seriously and embedding it within their culture, and we would consider ourselves one of those. But then there's also different geological or geographic areas of operations that would have very different social programs and or overall governance that we think will matter down the road. So we're paying attention to this, and we've set some significant goals and targets for that.
Okay, well, thank you guys both. Our time's just about up now. So again, thank you. It was very interesting to hear your perspectives on the market, especially today with so much going on in the energy field. Thank you.
Appreciate it. Thanks for taking the time.
Hi, everyone. I'm Ethan Zindler. I work for a division of Bloomberg LP called Bloomberg NEF, and our group focuses on tracking developments in what we call the energy transition space. What this means is that we write primary microeconomic research on trends in renewables such as wind, solar, geothermal, hydro, and other areas, as well as electric vehicles and other new area energy economy. For those of you who are familiar with clean energy, you may have heard of us as New Energy Finance. And for those of you who have a terminal or have access, you could check us out at BNEF Go, BNEF Go, NEFW Go, or bnef.com. It's my real pleasure today to be joined by Patrick Decoste, CEO of Boralex Inc. Many of you may regard the development of zero carbon energy as a relatively new phenomenon, but Boralex has been acquiring, developing, and owning clean energy projects since the 1990s. Here at BNEF, we've been tracking their activities since 2005 and have tracked their involvement in over 150 different power plants, many of which they still own today and others of which they've sold off over time. Boralex has been novel in its steady approach to developing relatively small wind, solar, hydro, and biomass plants in Canada, France, and the U.S. But with climate change, looming ever larger, the company has quite ambitious plans now to double its cash flow by 2025 by and investing in projects primarily in the U.S. They're headquartered in Montreal, and their shares trade on the Toronto Stock Exchange under the ticker BLX. All of you should have access to Patrick's biography online, so I won't go through it in great detail. But a few highlights are that he became CEO in December 2020 after spending 18 years with Boralex, starting as the company's first European-based employee, where he launched its successful wind project development business. And prior to joining Boralex, he was an engineer and project manager with EDF. So Patrick, welcome, and thanks for joining us today.
Thank you.
The subject of today's event, of course, is the role of institutional investors in infrastructure development. And I definitely want to come back and talk a little bit about that. But first, let's just start with some basics. Tell us a little bit about Boralex, your history, and then maybe a little bit about your current strategy.
Yeah, thank you, Ethan. First, Boralex is a 100% renewable energy company. We have started, as you mentioned, 30 years ago. We have developed a small hydro, then some biomass, wind, and we started in solar almost 10 years ago. We own 2.5 gigawatt in operation. We have doubled the size of the company over the last 5 years. And our plan is to double the size of the company again over the next 5 years. And our strategy is essentially to continue to diversify ourselves into, first in solar, to have a more solar exposure. Today we are really exposed to wind energy because this was the last wave of the company growth, and also to increase our exposure in the US, because this is a very, very big market and we are interested to go there, and also to start developing storage. We have a pipeline of 3 gigawatt of projects, so almost the size of the company today, in wind and solar, and 200 megawatt in storage already. And I think one thing, and we will come back, I presume, on that, is I think we have been an ESG company since 30 years, and we want to continue to be an ESG company with probably more structured and more disclosure, but that's also an important point of the company.
So just to follow up on a couple of those quick points. So first, maybe if you could talk a little bit more about storage and why is that, an area, obviously, this sounds like a relatively new area for you. Why is that an area of optimism and development? And actually go one step further and ask, is that really a requirement now these days if you're going to be a clean energy developer?
Yeah, I think there is two interests being in storage. One, if it is for the market and the system, the electricity system itself, where we are developing project. The more you have intermittent renewable energy like wind and solar, depending on natural resource, the more you need to have a management of the equilibrium between production and demand. And then storage is there to do this. You have some big storage system already existing, typically in Quebec or a part of France or Switzerland on their system. But in the system where interconnection of the network is not so important, you will need more storage. And sometimes storage is also very interesting for peak shaving, because the last kilowatt that you have to produce to be sure that you meet the demand costs a lot of money, cost more than the other one. And then sometimes just to displace this peak and make what this peak shaving is interesting. And on the other side, for a company like us, it's interesting because it's very complementary to the business we are already doing. Since 30 years, we are operating distantly, remotely equipment at a low cost. And if you add storage, it doesn't increase really your cost of operating, but it increases the service you can deliver to the system, and then it increases your revenue. So I'm sure that in the future it will be very, very important.
So it increases the hours at which you can provide power into the system, essentially, and sell potentially at higher, more profitable hours than you might otherwise, if I'm hearing you correctly.
Yeah, exactly. And it will smooth the volatility of the electricity price, and then increase the affordability of the energy transition. So it's good for the system and the market, and it's good for a company like us. And then there is a lot of development in storage, a little bit like in solar in the last years and presently too, but reducing of the cost. The industrial production of utility scale storage is reducing the cost. You are publishing a lot of things on that, Bloomberg, and this is also a good news for the system.
So the second thing that you mentioned, and maybe the equally important, was the one regarding the U.S. as a potential area for growth for Boralex. And as an American, and of course I'm here online just outside Washington, D.C., you're up in Montreal. I'm always happy to hear optimism about the U.S. as a market for growth for renewables. But tell me a little bit about why you think this is a good market to grow in over the next 5 years.
Yeah, we decided, we are in the US since 1998. We started there, but we have really decided 2 years ago in 2019 that we want to expand in the US because the market in Canada was, for political reason, closed for new development. And then we decided to allocate. We decided the US because there is a lot of coal production, there is a lot of nuclear production, and there is a lot of gas production of electricity. And then one day or another, this plant has to retard. And then we decided to allocate some resource from Canada and also some to hire some people in New York to start in the New York market. We are in the New York market with some hydro plants since 2003, and then it's the 11th economy in the world, just the state of New York. So we decided to go in this way, and we have been successful. Developing organic project, and then we have obtained 200 megawatt of contract last year, and we have bid some more just 2 weeks ago in an RFP there. We think also the connection with Quebec is important because understanding what is moving in the state of New York has some indirect impact in Quebec because of export from Quebec. And why the U.S. globally is we have reworked on our strategic plan, and it's really the place where the volume is there, and the commitment of Biden on the energy transition and on the infrastructure is so important, and the commitment of the different states also are very important. So we think it's a great thing. And I think just yesterday, the U.S. Department of Energy published a report saying that by 2035, 40% of electricity in the U.S. could be provided by solar. So it's so incredible. It's a continent. It's not just a country. It's a continent. It's great.
So a couple of things just to follow up on that. I mean, I'm struck by first, you mentioned, of course, New York State, and so that raises the sort of importance of state-level policy. But you also mentioned the Biden administration, and certainly we've seen some very positive pronouncements out of the Biden administration, but the most important potential thing to get the U.S. on track to building a lot more clean energy is legislation that's currently not passed by Congress. And so I guess my question for you is, how much of your strategy now is contingent on Congress passing both the infrastructure bill, which looks pretty likely to pass, but also this reconciliation bill, which is the one that would have a lot more support for clean energy in it?
Yeah, I think we are in the business in 30 years. So we have seen in Canada, in France, and in the US a lot of change of legislation. So we know that the most important point is to develop the right project, is to develop a project where fundamentals are better than other projects in terms of resource, size, grid connection, and these are the main points. So we're developing good project, and we think that the market will adapt itself. Typically, if there is a change in the ITC, in the tax credit for investment, and if this credit become refundable, this will create a change, but this will be the same for everybody. What we think is renewable electricity has become it's no more a subsidized business. It's a business which is competitive with the existing business, and we think then developing the right project is the right way to be sure that we have project, and not developing project which are depending on the tax, just on a tax law. This is very dangerous.
Understood. And before we move on, just to explain to the audience, here in the U.S., the production tax credit and the investment tax credit are two tax credits that have really been critical to the development of wind and solar in the U.S. There is talk in Congress of both extending those for a number of years forward, but also, as Patrick was mentioning, making those supposedly refundable, meaning that you could just take the value in cash, which is an important thing because it would mean you would not need to line up a so-called tax equity investor to exploit the benefit of the tax credit. Let's move on. I wanted to talk for just a moment about ESG and how that is factoring more and more into the work that you guys are doing. And then I want to come back and talk about institutional investors and the role that they play. But first, tell me a little bit, if you could, about ESG and how that's influencing some of the decisions you're making, and maybe more broadly, how it's influencing others as well.
Yeah, as I mentioned in the introduction, I think we are an ESG company since the beginning. We are in the solution. We're in green electricity in 30 years. We have the bonus we are paying to the employees in 30 years is named profit sharing. So we have really we know that we are investing for the long term. So we want to be when we arrive in a place, we want to be good neighbors for the next 30 years with the community. We know we have developed projects with community, municipality, First Nations, and also sometimes industry, but we are sharing the profit of what we are developing, because it's the only way to be sure that your investment will be safe for the long term, and that's what we are doing. So what we have discovered probably 3 years ago, is that when we made investor relation in Europe, we had a lot of question about this. And we say, okay, yeah, we're doing that, but you're not disclosing everything that you are doing. So we have really started last year to work on the disclosure of what we are already doing. And that was the first report we produced beginning of this year. And with this, we have structured 10 priorities You can find that in our ESG report, CSR report on the website. And with these priorities, obviously, when you are targeting things, you are measuring them, and then you are discovering that you can do better. And as a CEO, I don't want to say, we are in green electricity, then we don't have to do anything on inclusion and diversity, or we don't have to do in biodiversity. I think this is all important priorities for the company. Even our greenhouse gas emission from our own activity, we're measuring that for the moment, what is called scope 3, so including the indirect impact of our activity. So I think this is a way to be sure that we protect finally the value of the company and the assets on the long term. And that's my view of it. And as I mentioned, we have also some interesting project with First Nation in Quebec and in Ontario and in BC. And that's also something which possibly differentiate ourselves is to do project with the First Nations.
Great. Well, to build off the ESG theme for a second, so my sense is that ESG demands and investors demands that their funds are being put to work in ways that they think are ethically correct, for lack of a better way to describe it, is putting pressure on institutional investors, large pension funds and others that are composed of money from teachers and others, public workers, others. And we've certainly seen in the context of Canada, some of the largest pension funds being very active now in clean energy, whether it's in some cases literally buying projects, in other cases taking stakes in smaller developers. I guess a question for you as a developer of many small projects and many renewables projects, what do you see as the role potentially for institutional money in terms of furthering the energy transition?
I think there are different ways, because we, as you mentioned, we are developing small but also large project. Obviously, we are trying to take this band of because we have grown the company a lot, so we need to have also important project. But I think for institutional investor, they can invest in the company for the long term. I think the track record of the equity of Boralex is a good way to see that we are creating value on the long term for the investors. There is also, we have not gone for corporate financing or corporate bond really in the past, because we are more financing our business with project financing, but this will change, and it is a part of our strategy for 2025 is to obtain a credit rating and issue some bond in the future, and obviously if we can, I think normally green bond should be at a lower cost, because it's a lower risk. Because when you see all the actualities of this summer, we are not affected by that because we're in renewable electricity, and then there will be no big change in our business if you are correctly diversified. And I think it's a way to protect the money of the investors too. So I think that's a way to invest in renewable business, and possibly on some large project. We have developed some important project. It could be also a possibility for an investor to be a partner on a project basis too. But this depends on the size of the project and the size of the investor, of the money the investor want to invest in just a project. So I think there is many ways to invest in our business.
This may be a question maybe for a creative accountant or lawyer, but I'm curious your thoughts, which is, we've talked about the importance of tax equity being the primary source of capital for U.S. project development. Is there a route now for institutional money to play a role in tax equity, or is going to need to be some kind of policy change to try and unlock that pool of capital to provide tax equity credit?
I'm not an expert personally. Maybe you should ask my CFO about the details. But my understanding is that tax equity investors are really, sophisticated investor in the renewable business. They understand why it's so important. They understand that it's a way to invest their money, make the right return, and also allow the energy transition to be there. So I think there will be a lot with the ambition when I mentioned going from 4 to 40% of the U.S. electricity coming from solar. There will be a lot of place to invest for investor, and it's certainly less risky than to invest in fossil fuel companies and fossil fuel investments. So I think that's the way I see it.
We've got all of just 1 minute left, unfortunately, and thank you for your time. This has been a really interesting conversation. What one thing would you say would be the thing that keeps you most up at night, the biggest concern you might have about not doubling in size over the next 5 years? What could get in your way? What's at the top of your list of things that could set things off track?
But the most important point is, if you want, yes, we want to double the size of the company, but with a disciplined growth. This is how we brand the company. And I think disciplined growth means maintaining the return as much as possible and giving the premium of the risk we're taking to the investor. And that means, yes, there is a lot of volume in the market, but you need to find, the diamond where they are. And so we are working on that. So I have known the market where it was difficult to have financing, and know it's hard to find the right project. And this is why we're developing organically. So organic development, right return, that's really the thing I'm saying to my team probably every day.
Got it. So finding the right projects in the right places at the right financing sounds like the key. Excellent. Well, listen, Patrick, thanks so much for this quick conversation, but really interesting and enlightening, and best of luck to you in the U.S. and beyond. And thanks for joining us today.
Thank you. Thank you very much, Aidan. Have a nice day. Bye.
And we're very pleased to have with us the CEO of Lion Electric, Marc Bédard. Well, thank you very much for being with us. We appreciate your time. And I want to start with the real difference for Lion Electric. We just saw coverage initiated on the company, and one of the things that the analysts at that particular bank highlighted was first mover advantage. What is it that you do that sets you apart?
Yeah, thanks, Amanda, and thanks for having me with you today. I mean, many things. The first thing is probably, we've been doing this for 13 years now. Some people are saying Lion is an overnight success. 13 years in the making, and I think this is true. So right now, there are so many things we're doing, but we are real, Amanda. We do have vehicles on the roads right now. We have 400 vehicles on the road. We have over 13 million kilometers driven as well, and real manufacturing capacity as well. So some OEMs are going on the public markets right now, and with a good business plan. And obviously, we're way past that. And we have real vehicles, real customers, manufacturing capacity, a team of 900 people, so many things to say.
And of course, it's a space that is attracting a great deal of attention, electrification in general, of course. Give me your sense of where the market is today versus the potential, ultimate potential for the overall electric truck market.
Yeah, we've just seen the tip of the iceberg so far. I mean, the market, we started, Amanda, you probably remember, we started selling our school buses in 2016. And we were really the first one to market. Right now, we are the leader on the electric school bus side. And it's always, and it was always starting with the 1 unit, 2 units, and a few units. And then, we're getting right now orders for hundreds of units from customers. So we see that this is really accelerating with customers right now. And the customers are getting more and more sophisticated with respect to electrification. They understand the total cost of ownership. They understand that paying a higher sticker price that you will recoup through a number of years is really worthwhile as well. So not only the people and the operators are doing this for the planet, but also to make money, because you can have a great total cost of ownership now with electric vehicles.
Mm-hmm. You've got a pretty sizable order book at the moment. Can you give us a kind of a sense of who the clients are, what the types of vehicles are that makes up that order book?
Absolutely. We have an order book of about 965 units, and most of them are buses. And we see a lot of new customers in this order book, such as IKEA, Green Mountain Power, Pride Group, DN Ross, Zoom, Casella Waste Systems as well. And also those customers are adding up to the other ones that we've had. We have Amazon as a customer, but also we have First Student, National Express, Student Transportation of America, Canadian National Railways, Con Edison, Molson Coors, and many, many others as well. And we saw also Amazon, putting in a new order for 15 Lion 8 tractor trucks. And we also saw Prince Edward Island just lately putting in a new order for 35 Lion C buses also. And we saw a big order from First Student for 260 buses about 3 months ago. So you're absolutely right. This order book is building, and this is exciting.
Having said that, as big a number as that is, 965, you're targeting a pretty dramatic growth rate and production output level. You're building a new plant, so let's start with an update on progress in Illinois to completion and what gets you in terms of your ability to pump out vehicles.
Yeah, this is going so well. You probably remember what happened on May 7th. Well, if you don't, I do. On May 7th, so many things happened, but this is the day that we became public on the New York Stock Exchange and also on the TSX, but it's also the day that this morning, that morning we made the announcement with Governor Pritzker, and we made the announcement of this 900,000 square foot facility in Joliet, Illinois, and right now it's 80% completed. So this is great, and it will be the largest EV factory for medium and heavy duty vehicles in the United States and in Canada as well. Our manufacturing capacity will be 20,000 units a year. It's going very well right now. We will take the occupancy of the building before the end of this year, and then early in 2022, we will be receiving the manufacturing equipment. We will be ramping up the manufacturing capacity, and we are planning to have our first vehicles to be rolling off the line during the second half of 2022.
And ultimately, how many vehicles can you produce at that facility?
Yeah, 20,000 a year.
And so when you think about kind of the role where that would position you in the market, where does that suggest your competitors are and policies are around electrification and the battery technology is? When we say 20,000, what are we assuming there?
Well, we think we will become a very significant player. As I said earlier, we're already the leader in electric school buses. We're very well positioned on the truck side as well. So 20,000 units, that's Amanda, that's on the US side. We already have a manufacturing capacity of 2,500 units on the Canadian side. In total, we have about 23,000 units of manufacturing capacity. This is pretty significant, and in my opinion, this is only the beginning. So we'll see, what the other OEMs will be doing. But I'm expecting that the electric market will be pretty big and pretty fast. I think we're seeing right now the amount of money that all the governments are putting in electrification. You probably saw Mr. Trudeau about a month ago, or maybe a little bit more than that, just saying he's investing $2.75 billion to replace 5,000 transit buses and electric buses in Canada. The Quebec government invested, or are investing as we speak, $250 million over the next 3 years. You saw Mr. Biden investing $5 billion over the next few years as well, and also, many billions of dollars in California. A lot of those amount of money right now are going into electric school buses. And Amanda, for the right reasons. And this is the reason we started that at the beginning. There is no reason for our kids to still breathe those diesel fumes. And right now, the total cost of ownership works pretty well, and with the subsidies that the governments are putting in, I think, the whole market is going to go electric before long.
And of course, we have mandates for electrification of fleets around the world. How will that change the world for you? You do have an early mover advantage, of course, and access to all kinds of resources as a result. When every OEM is working in the space, is it better for Lion Electric or worse?
It's better as long as they do a great job. And at the beginning, like a few years ago, the people were they were confusing electric vehicles, like if all of the vehicles were the same and in the same basket. Well, it's not. And that's the same thing with cars, right? I mean, some cars are very good, some others are not. That's the same thing with school buses, with buses, and with electric trucks as well. The people are getting it now, and what the clients are looking for, they're really looking for purpose-built. They're looking for top quality products, purpose-built, to be electric, and this is what we're doing at Lion. So as long as a good OEM is coming to the market with a great purpose-built electric truck or electric bus, we welcome that, because this is a huge total addressable market. So the more great products we have, the better it is, and it's not a one-takes-all. I mean, there is room for many great OEMs in this market.
Of course, the battery technology is a key differentiator. What's different about Lion Electric's?
Several things. We started working on our own battery packs many, many years ago. We were in 2012, 2013, and we decided that we will not be waiting for the other companies to come up with something before we react. So back then, we decided to manufacture our own battery packs. We started buying modules from LG Chem, and we've invested a lot of money and time on our proprietary IP. And this IP, well, there's a lot of IP in a Lion bus and in a Lion truck, and it starts with the software. But there's also the battery management system, there's also the thermal management system, the BTMS. We've been manufacturing those battery packs with our own technology for many, many years. Also, Amanda, we like multi-sourcing. Multi-sourcing is great, and also on a number of years also to make sure we're having a commitment with those suppliers for many years. So at the same time that we are developing our proprietary technology, we are buying from third parties. And if you heard the announcement I've made with Mr. Trudeau a few months ago, and also with Mr. Legault, this is very exciting. We are building this battery factory. This is in Mirabel. This is on the tarmac. Basically just beside the tarmac of the Mirabel airport. It's a construction on this 1.6 million square foot of land, and the battery factory will be located over there. It will have a manufacturing capacity of 5 gigawatt-hour per year. That means this is enough to put batteries on 14,000 of the Lion's vehicle on an annual basis. So this is very, very exciting. If you're looking, you were asking me the question about how many units we can produce and what is it going to change. So our total manufacturing capacity is about 23,000 units, and we will have the battery manufacturing capacity for 14,000 of those 23,000 units. So this is great. We're controlling the technology. We're shaving the cost, absolutely, and also we're controlling the form factor. And something we do at Lion is always having a perfect weight and balance on all of our trucks and on all of our buses as well. The devil's in the details, and we're really taking care of those details.
And one of the details I know that you're focused on is cost per vehicle. You have, I think, a pretty ambitious goal about reducing. What goes into the mix there? How will you reduce your costs?
It's mostly with the battery factory that we are building right now. When we know that about 30 to 40% of the cost of a vehicle is within the batteries, there are a lot of savings to be done. So part of our vertical integration strategy is going through this great initiative, with the battery factory. So we think we will be shaving down a lot of cost. So not only are we controlling the technology and having a better product, but also saving on the cost. Also, obviously, the volume. The volume is really helping. So having more volume on an annual basis, then we can negotiate better pricing with that. And since we will not be the only one, I mean, at the world level, there are more demand than ever for electric, and we are also expecting a kind of overall decrease on the cost of some of the components. So all of that will make a very big difference going forward.
And some of that, of course, will play a big role in your goal to be cash flow positive, free cash flow positive by 2023. What's the risk to that outlook? What stands in the way of getting there?
It's a matter of volume. We need to get the orders to be there as soon as possible. We're making big investments right now in Joliet, Illinois. We're making investments in the battery factory as well. And we want to make sure that we will get a very quick return on investment on those major investments that we are having. So we're working very hard with our clients to make it happen as soon as possible. Also, we hope that the governments will kick in on this. I mean, the electric right now, the holdup is a little bit the higher sticker price at the beginning. So even if your total cost of ownership is very good and you're gonna make money over the years, you still have to deal, with a higher sticker price. And this is where the governments, need to invest a little bit more money, and not forever, only for a certain period of time. And we're saying it's about 4 or 5 years to make it more affordable for the operators to go to electric. We want to make sure that the operators, they have a smooth transition to electric, and part of it is coming, with having a little bit of help on the financing side.
And I guess governments can also be supportive on the infrastructure side. That seems to be one of the big challenges with broad adoption. Where are we on infrastructure, charging stations, all the components we would need to see the kind of volume that you're talking about?
Yeah, well, it's a little bit the same thing. What we've been doing at Lion, we created that group called Lion Energy, and to make sure there's a smooth transition to electric for our customers, they need to focus on their business and not worry about having their charging infrastructure and all of that. The federal program by Mr. Trudeau, I think, is a great one because it's paying, for some of the cost of the electric vehicle, but also for the charging infrastructure. So this is good, but also as an OEM, we are making sure that we're taking care of everything for the client. And this is including finding the right charging infrastructure, meaning is it a level 2? Is it a level 3? If it's a level 3, what kind of power do they need? Is it like 24 kilowatt, 50, 62, 100, more than that? And we are a reseller of many brands like Flow, ABB, ChargePoint, UV, and many others as well. Our goal when we're doing this is to make sure that the client is doing what they are supposed to be doing, and they earn money delivering their services, and they don't have to worry about going electric. We take care of that.
When you think about the future and being cash flow positive, where do your CapEx plans fit into it? Will you continue to be investing as heavily in technology and innovation after 2024? We do, Amanda, and that's the only way I know to be successful. We have a first mover advantage, as you said. I fully agree with that, and we need to make sure we will keep it. And the battery technology, for example, will be evolving very fast within the next few years at the cooling system, at the heating system, but also at the cell system level. So all those systems will really be evolving. We need to invest more money. We need to make sure that we're getting a better and better product that will be evolving within the next few years. Diesel has been there, for so long, and now we have those great products with electric vehicles, but we still need to invest, more money to make sure it's going to be even better. And when it comes to that money, do you have the capital you need, or will you be looking for capital injections in the years ahead?
No, we don't need to be looking for more capital. I mean, we're all good. When we went public, I mean, that was exactly the goal. We had two main growth initiatives, and that's the battery factory and also the U.S. Plant that we are building right now, and also to keep investing in R&D and hire more people. We're more than 900 people at Lion right now, and we are growing all the time on a weekly basis. But no, we don't need more money right now. We're pretty good.
And so when you look ahead, if we think about talking about a year from now, what are the couple of things you hope to have achieved? What's top of the list?
We're executing the plan. So the plan is very clear. It's what I said, the battery factory, the US factory as well. We are delivering vehicles on a regular basis, and we are one of the very few companies who are manufacturing and distributing electric vehicles at the same time that we are finalizing the development of some other vehicles as well. So we have 7 purpose-built electric vehicles right now, and we'll be launching 8 additional models within the next 15 months. And also, we are attracting the best people. I think Lion is a very good place to work at, and the people, they want to work in that type of company where we're taking care of our kids, we're taking care of our people, we're taking care of the planet at the same time, and what we are offering to our customers is very much appreciated, and they can make money with it. So I think we have a group of 900 very passionate people, and this is growing.
Mark, thank you for your time today. Appreciate it.
Thank you very much, Amanda.
Mark Bedard is the CEO of Lion Electric.
Thank you for joining me today for Bloomberg's Canada Fixed Income Conference. It's been a very eventful and volatile week so far for the global markets. Investors are grappling with the Fed policy outlook and fears of contagion from China's Evergrande Group. Also, concerns about a slowing economy and elevated inflation linger. But for the mining sector, the future looks very promising. A global push for a carbon-free future means millions of tons of raw materials will be needed in the future. But the mining sector is also facing a dilemma in that in the near term, we do see some kind of weakness in the economy here and there. And even though longer term, the outlook is very bright. Joining me today are 2 mining executives who are going to talk about what's at stake, how the mining sector is going to tackle this dilemma. Without further ado, let me introduce our expert panelists. Daniela Dimitrov, she is Executive Vice President and Chief Financial Officer from IM Gold. Steve Douglas, Senior Vice President and Chief Financial Officer from Hudbay Minerals.
Nice to be with you, Yvonne.
Thank you. Happy to be here.
Thank you. We had the FOMC decision yesterday, and the Fed basically was signaling that they're going to start tapering really soon, as early as November, and the process is going to be completed by mid next year. But again, when you look around, it's not difficult to see signs of weakness in the economy. I'm sure you know August payrolls numbers, those were a red flag. And because of the Delta variant, consumers are becoming more and more cautious just because it seems that COVID is never going to end. And also fears of a China housing crash. And just seems to me that the recovery people were talking about is kind of like losing steam. So I wonder, kind of, what's your view? How do you feel about the economy? And do you think the worries are kind of not warranted? And are we really on our way to a full economic recovery from COVID?
Well,
Maybe Danielle, you can.
Oh, sorry.
Oh, okay, sure.
Oh.
No, Steve, you go ahead.
You know, I think the jury's still out on a lot of those questions. I mean, frankly, I must confess to be a terrible bond person, because when you look at rates today, even whatever easing they reverse, and whatever rates that creep up, I think we've got a crazy low interest rate environment in any event. So I'm not sure 100 to 200 basis points either way is going to make a difference in terms of how people are viewing investing. And when I look at, and then of course the inflation question is really a question in my mind of, is it transitory by virtue of the fact that the supply chains are a mess? I think, you know, we've seen it across the board. I think everybody has seen it across the board, which is that a friction that has generated higher costs for things just by virtue of friction. I mean, we all know the anecdotes around anything to do with entertainment or leisure activities. Trying to get a bicycle or a kayak or anything along those lines is very difficult in this day and age. Looking at our business specifically, I think you hit the nail on the head at the beginning. The biggest driver for us, I think, is the commodity cycle, and what is the decarbonization of the world going to do for demand, particularly in the copper space. It should spin off into gold as well, but I mean, clearly copper comes to mind. So for us, we think the outlook for our primary product, which is copper, is very robust. When you couple it with decarbonization, the tremendous difficulty it is in terms of permitting new mines, and frankly, the timeline from discovery to production is not getting any shorter.
I would add to that, and Steve, you touched on it, you know, certainly the Fed thinks that inflation is transitory. If we look at their predictions that they released in September, their projection for inflation for the most part for 2022 is just over 2% compared to over 4% where we stand today. And we certainly have seen it in some of the commodities that have gone up and reached peak highs in earlier this year, such as lumber, such as steel, and such as iron ore, that have since come down. And we've seen iron ore take a tremendous tumble from its high in May, and lumber has come down closer to the prices that we've seen in 2018. So certainly that would suggest that the inflation that we're seeing is supply chain driven, disruption driven, like you talked about, Steve, and that 12 to 18 months from now, when some of those the disruptions are expected to clear, that we're going to be back to where the Fed thinks we should be, which is just over 2%.
Both of you mentioned inflation. I wanted to know, kind of, from your perspective as mining companies, because company, like almost every single senior executive talked about cost pressures during earnings calls. So I wonder, kind of, if you could share your thoughts on how you are seeing cost pressures, first of all, and also how is that affecting your business?
We're building our fourth mine in Northern Ontario. We started construction in July of 2020, and we certainly have seen some of the cost pressures that we've just talked about in copper, in steel, particularly also in labor, some of that being driven also by the impact on productivity that COVID has had, which ultimately has resulted in an increase in labor costs. You know, so we've certainly seen it in energy as well, not just in Canada, but in our operations in South America and in Africa as well. How the industry has reacted, and you'll see and you'll hear commentary about the fact that our industry has gone through cycles of increased costs and increased capital costs and increased operating costs. And the industry at that time responded by decreasing our cutoff grade. So some of the metrics that we use in estimating our reserves and resources. I would think that today, what is different today for our industry than was before is the fact that we haven't reacted in that same manner. We've been a lot more disciplined around maintaining the price deck and the assumptions around the calculation and estimation of our mineral inventory. We've been more disciplined in our capital allocation, and we have not gone, at least not yet, chasing growth as a result of that. So I think that it's different for the industry today than it was in the last cycle when we saw pressures on operating costs and capital costs.
I concur, and the refrain that shareholders are obviously going to take into all of this, and we've seen it in just recently with some asset trades, is discipline, discipline, discipline. Unfortunately, our business is rather notorious for taking very large-scale bets, and the one thing that we all suffer, and IAMGOLD is clearly going through it now, is every one of our developments are going to straddle cycles. It's just the way it is. The other element that I would suggest is putting cost pressures in addition to the ones we've enumerated is shipping. We move a lot of tons around the world by virtue of the fact that we deal with smelters in the Far East, and our products are obviously not generated there. So shipping, I've heard anecdotes of 3- and 4-fold increases on global shipping. And we've had a couple of occasions where you have to push folks to honor their contracts because the costs of the global shipping has just gone through the roof. That's just one example. You also, as we all know, time is money. Time, that corny old saying is absolutely true. So if you're in the midst of a very large capital spend, we just went through this at our operations in Snow Lake up in Manitoba. Where we were finishing up on the construction of a refurbishment of an old mill that was there to enhance our recoveries in the gold circuit. Just delays. And delays cost money. You've got people that you've mobilized, you've got resources you've mobilized, and you've tried to sequence things, but these delays definitely put a kink and add additional costs to what it is you're trying to do.
Yeah. Both of you also mentioned about kind of this commodities price rally. When prices were at multi-year highs a few months ago, and also prior, sometime late last year, a lot of folks were talking about this kind of new commodity super cycle. But now you don't really hear people talking about it because prices kind of come down a little bit. But what do you guys think? Is this a real kind of new commodity super cycle, or it's just a structural bull market like some analysts called it? And also for Steve, how far can copper prices go? What do you think? And also for Daniela, is it over for gold because Fed is going to it will start tapering really soon?
I think, look, how high can prices go? It's anybody's guess. And I'll key on particularly copper for a second and let Daniela deal with the gold commentary. You mentioned earlier on, and again, not to continually repeat myself, but the copper price we think is in for a structural change, only because of the fact that all this talk about decarbonization, you're not going to do it without copper. And if you look at any credible prognostication as to what it is the supply side is going to look like on copper, we've got a structural deficit of anywhere between 5 to, I think, 7 million tons starting in the next 3 or 4 years. And again, when you look at the perception around mines, and I think it's somewhat erroneous when you look at what a lot of the industry is looking at doing now. I understand, we're in one of our competitor companies in the midst of trying to build a mine that's entirely carbon neutral. And this is obviously something that is top of mind for the mining industry. But I do believe the structure is being, the table's being set, at least for those batteries, for those metals that will contribute to the decarbonization of the world. You have no choice, because we are not built as an industry to supply these kinds of shocks. So you're going to have to either stimulate or allow to be built an awful lot of the extractive type industries that would get the sort of the scarlet letter in the environmental side. You're not going to decarbonize the world without them. It's just not going to happen.
Daniela, is it over for gold?
Well, certainly. Well, you know, the gold bulls will tell you that they don't believe that inflation is transitory. They believe that all of the liquidity that has been injected into the system has caused structural challenges, and that inflation is here to stay beyond 2022. And so the gold bulls will tell you that they don't think it's over for gold. I think the key thing, it goes back to discipline. And I think, you know, certainly the gold industry has spent the last number of years working out its mistakes of the past, trying to bring costs down, trying to be a lot more disciplined around capital allocation, running reserves at 1,200, maybe 1,300, and not letting that discipline go when the gold price has gone up and reached almost $2,000 an ounce. So I think that discipline is, you know, I expect that discipline will continue. And therefore, you know, I was working with another gold mining company when gold got down to 1,100, and so I always say that at 1,300, I think we're lucky to be running our businesses as such. At 1,600 is fantastic, and at 1,800 is, you know, is a gift. So. So I think, you know, again, discipline combined with prudent capital allocation and cost containment is key for the industry, so that we're not so worried. We're not as worried about whether gold is 1,600 or 1,800 or 1,500.
Yeah. So because IAMGOLD and Hudbay are both Canadian companies, and this is a Canadian conference, I'll have to ask a Canadian question. So the election this week in Canada doesn't really change the status quo. The Trudeau government has been really keen on battery metals, critical minerals, to make Canada a leader, a world leader. What do you think? Like, how Canada can go beyond just words to make it easier for miners? Like, what do you think Trudeau should do, or his government should do, in terms of like actual maybe subsidies or provide coordination all through the supply chain?
I think transparency and definition of the permitting process is really critical. From a capital attraction perspective, you know, whether the government contributes from a, you know, capital to further that particular aspect of the industry is helpful, but at the end of the day, it is never going to be enough to allow certain of these projects to, you know, to progress to actual production, and therefore third-party capital is critical for Canada to be attractive as a jurisdiction to that third-party capital. You need to have transparency from a permitting perspective. You need to have timelines that people understand, and certainty around the fact that those timelines will be respected and will be met, so that capital knows whether we're talking about a 2-year permitting process or an 8-year permitting process on that front. And those kinds of factors at the end of the day are really, really important to attract third-party capital to Canada to invest in the industry.
I couldn't agree more. I think Daniela's comments are spot on. Predictability, certainty. I mean, we are uniquely positioned as a country to, you know, both find, develop, and bring to market new deposits here in our country. But we also have to bear in mind we're uniquely equipped as a country. We have a workforce that's quite familiar with mining. Mining is not something that is a difficult concept for people to process. It's fun. Daniela mentions Côté. I grew up in the shadow of many head frames up in Timmins, which is a well-known gold belt. And I think the attitude that governments had at that time was that we can, or at this time, is that we can develop mines. And the mining industry is probably further ahead than most people realize in terms of our environmental initiatives, our focus on ESG, and bearing in mind, too, we're bringing metals to market that, frankly, are necessary to decarbonize the world. We can't lose sight of that. So I think the government, and I don't want to put words in anybody's mouth, but we're not looking for handouts. We're not looking for we're not looking for the government to say, hi, we're here from Ottawa and we're here to help. We're looking for just process and that we can gain certainty from, equity, and frankly rationality when you're looking at these things, because anyone in the line of business can cite examples of silly season in terms of regulatory decisions. But if you just give us the environment, we'll bring the tools and the energy and the expertise and make it happen.
Cool. I'm sorry, we only have like 30 seconds left. So maybe a few words on the ESG part from both of you.
To Steve's point, it's been important to us, social license to operate. It's been important, not just in terms of operating in Canada, but other parts around the world. Probably, I think we're all struggling to comply with the various standards, reporting standards out there, and trying to figure out, which one to pick and how many to pick to make lots of stakeholders happy. So probably some clarity, I think, that is expected from the regulators is important.
Agreed.
Okay. Very cool. And that concludes our session today. Thank you, Daniela and Steve, for joining me today. And I also want to thank our viewers for tuning in. Till next time, take care.
Thank you.
Thank you.
Thank you.
Hello, and thank you for joining us for today's discussion on the insurance industry. I'm Kevin Orland, and I cover Canadian banks and insurers for Bloomberg News. With me today are Lee Chalmers, Senior Vice President, Head of Corporate Finance and Capital Management for Sun Life Financial, and Helena von dem Hagen, Global Treasurer and Head of Capital Management for Manulife Financial. Welcome to you both. So at the start of the summer, it looked like the accelerating vaccination programs would have allowed a full reopening of the economy by now. However, vaccine resistance and the spread of the Delta variant have prevented that. So how is the prolonged nature of the pandemic affecting your businesses? We'll start with Lee on that one.
Well, thanks, Kevin, and thanks for having me. It's great to be back. It's hard to believe it's been a year since we had this conversation, and who would have thought we'd still be working from home 18 months later? So it's great to be here, and it's great to see Helena again. I guess what I wanted to do was talk a little bit about sort of how our business has been impacted by COVID. So sort of going back to the beginning and really touch upon a few aspects of it. Starting with our clients, maybe touch a little bit upon digital and how that's really changed our business. Looking at the performance of our business, and then lastly, on our people, because obviously we've all had a big shift as we've been adjusting to this pandemic. So maybe starting with the clients. Obviously, clients are at the center of our strategy. Everything we do revolves around the client, thinking about how do we serve our clients. So, as we entered into this pandemic, we were already shifting to using more digital tools, but the adoption rate wasn't really there. Right? People weren't really willing to go out and talk to their advisors remotely, virtually. So we continue to see a big shift and being able to access our clients and having that open dialogue between our clients and our advisors. So I'd say that's been a big change. The other part of it, as we pivoted with the pandemic, it was really about getting the right products and services to our clients. We introduced automatic underwriting, which allowed us to continue with underwriting policies without having the lab work. So I think there was great traction there. The industry as a whole moved more to e-signatures. And I think the real push we did was around, those partnerships and, introducing virtual care. So making sure that our clients could continue to get the care they needed. And I have to say, 18 months in, I'm shocked at how many times, we've been online connecting with the doctors. My kids have to meet their doctor, so we're always online, and it's now really become part of sort of that regular health care and how we interact with our doctors. So I'd say from a client perspective, we've really pivoted, and that continues. And I'd say overall, the pandemic has really reinforced our purpose. So helping our clients access the care they need. So I think that's really sort of shone throughout the entire pandemic that we've been dealing with. On the digital front, I wanted to touch upon was really about, again, we had the digital tools rolled out. We've certainly continued to see the acceleration of, our advisors being enabled by digital tools. As we've gone through lockdowns, obviously it's gone through series of waves, across all our geographies we operate in. And the ability to access our clients remotely has allowed us to continue to push through those sales and access our clients and continue the funnel and the pipeline of our business. So I think that's been excellent. I would say as an organization, we're really focused on everything digital. So we refer to it as the digital enterprise. And I'd say the pandemic has allowed us to continue to accelerate that. We're investing in our tech stack. We're continuing looking at our client journeys. So I'd say more than ever, it's really important to make sure our clients are able to access and processing their claims is easily pushing through our applications. So I'd say from a digital side, we continue to see significant acceleration. And maybe just a couple proof points, in Canada, we have our digital coach, Ella, and Ella has connected, with members more than 3.4 million times. How we're seeing that flow through in our results is, we're seeing increased wealth deposits, just year to date, at Q2, we're at over 400 million in additional deposits as a result of those digital connections. Same with insurance coverages, over 600 million. And then I'd say in the US, we invested in a company, Maxwell Health, and that was a digital benefits platform. And as a result, through 2020, every single one of our enrollments were done virtually. So a real success. And I think if anything, the virtual enrollments demonstrated the value of that tool and allowed us actually to accelerate sales because of that. And then in Asia, I'd say the same thing.
All right.
So, yeah.
I'll continue.
Okay, so I think those are the key points. I did want to touch upon, so the impact on our business, but maybe why don't I turn it to Helena? She can touch upon it, and then I can come back and maybe touch upon a few other things. I don't want to take up all the time.
Yeah. So Helena, how has the sort of prolonged nature of the pandemic been affecting Manulife?
So Manulife and the industry in general, if I may. So I think insurance companies in general proved quite resilient, both operationally and from a business perspective. And a lot had to do with the digital tools that we had at our disposal, and we already put them in place prior to the pandemic, but very similar to Sun Life's experience, the adoption rates were not as strong as we would like prior to the pandemic. Of course, the lockdowns, restrictions on physical distancing necessitated the adoption of those tools, and we were very happy to see it, and we believe that this trend will continue. Like, for example, in Canada and Asia, 97% of our annualized premium equivalence is accessible to customers through the non-face-to-face solutions. We also have capabilities to accept digital claim submissions. We enhanced throughout 2020 our straight-through processing. And just like to prove some, again, points regarding the digitization, in the US, 100% of the insurance contracts were delivered digitally at the end of 2020, compared to 20% before the pandemic. So a very rapid increase. And in Canada, the comparable numbers stood at 60% for the electronic delivery of insurance contracts in Q4 2020 relative to 40% prior to the pandemic. So a rapid increase. So I would say, like, when you think insurance and COVID-19, maybe the first adjective that should come to mind is resilience. The same was true about our staff. Literally overnight and with no hiccups, we moved to working from home. For Manulife, over 95% of our global workforce of over 37,000 staff, including Asia, has worked from home at some point during the pandemic, and currently 98% of our North American staff continues to work from home. So this resilience, combined with the fact that pandemic also increased awareness of benefits of protection, explains also our business results. I think in case of Manulife, another adjective that's critical is diverse. We have lots of diversification of our businesses. We are present in Canada, US, and in Asia. We are one of 3 Pan-Asian insurance companies. We operate in a very meaningful way in 13 markets across Asia. Asia already contributes 1/3 to core earnings of Manulife. We are also diversified between insurance and global wealth and asset management that contributes 1/4 to our earnings. And within global wealth and asset management, there is a diversification of lines between retirement, retail, and institutional. So this diversification, again, greatly contributed to the strong business results. We reported 5.9 billion net income in 2020. The year-to-date results, first half of 2021, stands at 3.4 billion. So I would say a very resilient and impressive performance from the insurance industry broadly, of course, including Manulife, my own company. I also, if I may, wanted to comment because on risks that were feared but didn't materialize. So I think there was a lot of anxiety when the pandemic struck regarding our business and the insurance claims. What was not appreciated enough and came through very strongly is diversification within our insurance risks between mortality and longevity, for example. Similarly, between certain business lines such as travel insurance and other business lines such as dental claims, etc., like that sort of tend to offset the impacts on the bottom line throughout the pandemic. So and in general, I don't think it was appreciated how well the mortality risk is managed within insurance, how we use the reinsurance risk mitigation tools to keep it under control. So these risks pertaining to pandemic, health, death, life insurance companies' problems, this did not materialize at all, I would say. And similarly, there was a lot of anxiety at the beginning of the pandemic pertaining to credit risk. And again, arguably partly through the support and action of central banks and access to credit, etc., but also in general, I think disciplined approach in the books of Manulife for sure, and insurers maybe more generally, we didn't see like widespread defaults that would hit the bottom line of insurance companies. Instead, like some other concerns emerged, like most notably concerning commercial real estate market, office and shopping malls and similar. So I just found it interesting how our perceptions at the onset of the pandemic were sort of modified by the events as they unfold. Thank you.
So Helena brings up an interesting point, which is that the pandemic really it sort of altered a lot of the typical insurance claims and usage trends that people had seen previously, and also probably would have expected. These things changed in ways that people wouldn't have expected during the pandemic. So I was wondering, Lee, if you could talk just a little bit about how Sun Life saw those claims and usage trends change during the pandemic, and is there any sign that some of those trends are returning back to normal, or have some of them been permanently altered?
Yeah, no, and I think that's a great question. And I mean, Helena touched a lot upon, about the benefits of the diversification of our businesses. So, I'd say Sun Life is the same. And I'd say not only it's about the diversification by products, but it's also the geographic diversification. So when the pandemic hit, it hit in Asia, and we sort of thought, great, we're a global company. It's just impacting our Asia business. But then, as it came to become a global pandemic, obviously, our entire businesses were impacted, but impacted at different times. So I think because of that diversification, we were managed to sort of weather through the storm. And so, like Helena said, sort of how our businesses interacted really allowed us to continue to perform and produce strong results. So in terms of trends we saw around insurance experience, I'd sort of start maybe with our U.S. business, where we have a stop-loss business that, because less people are using their benefits, we've had very, very strong performance. We also have a group life business that, of course, are having some implications as a result of mortality claims coming through, but overall a strong result on our U.S. business. So you're seeing that diversification. I'd say in trends we're continuing to see. U.S. unfortunately varies state by state, varies depending on the level of vaccination rate. So again, we're seeing diversification across states, but we are seeing still lower usage around our stop loss business. And we continue to see, particularly in Q2, we continue to see some life mortality claimings coming through, unfortunately. Turning to Canada, I would say, again, we didn't ever see significantly high mortality claims coming through. Again, that goes to the risk mitigation we have in place, whether it's the risk selection at the outset of who we're insuring, or also the use of reinsurance, as Helena had mentioned. So not being impacted significantly by life claims. We did see a lower usage of dental and health benefits. We are seeing that start to return back to sort of normalized pre-pandemic levels. And then on LTD claims, obviously that's something we're continuing to manage and monitor. And so maybe going to our last geography in Asia is unfortunately, with where they are in the pandemic, we, in Q2, by the end of Q2, we're seeing some geographies, China and Hong Kong starting to introduce lockdowns again. Vietnam was a country who fared very well through the process, and now unfortunately they're in lockdown, and so we're seeing some implication and headwinds coming through on our bank assurance sales as a result of the banks being closed. So again, varies geography by geography, but seeing some positive signs, and unfortunately some countries still sort of weathering through the pandemic.
Okay. So now over the past year, we've also seen interest rates rise. They're off their lows of the pandemic, but they are down from where they were at, the start of this year. So I'm curious, how have those moves and some of the fluctuations we've seen in the yield curve affected your company's financing strategy? Let's start with Helena on that one.
So I have to say, generally, when we entered the pandemic, we entered with strong capital levels and strong liquidity and very high quality asset portfolios, and I think this is true across the industry. However, the volatile markets that ensued, and especially the first few months of the pandemic, when I describe it that the markets in many ways lost their identity, and there was a great uncertainty with respect to the economic developments and the central bank's response, etc. It greatly affected my thinking horizon when it comes to pre-financing actions. Normally, we never like to be squeezed into the markets, so I say one transaction ahead of the markets, meaning you go where you don't quite yet need it, but just to optimize the size and the price. But we started thinking in the categories of like up to 12 months of pre-financing. So macro uncertainty certainly made this approach prudent, and historically low costs made it very affordable. In fact, like this allowed us to also choose the markets that we want to access. Manulife greatly diversified its funding sources. We are now very well established in 4 markets: in Canada, in the United States, in Singapore, and in Formosa, Taiwan. Through those 2 Asian markets, we have access to the Asian investor base and provide alignment with our presence on the continent there. So during the 2020 and 21 to date, we issued $6.3 billion in various markets and various instruments. We also redeemed close to $4.5 billion. So it wasn't only like on a net basis, and given like the preceding years where we largely leveraged, we are almost like net. But still, it's been a very busy time to the Treasury. And the communication to stakeholders, including rating agencies, was critical throughout because of the timing difference between the issuance and the subsequent redemption that created spikes in the leverage ratio. For example, we issued in the Formosa market over $1 billion US in 40-year senior debt in September of 2020, but redeemed $1 billion in June of 2021 at 165 bips cheaper. Our issue, like on a net basis, our issuance was relative to the redemption, saving us $12 million in interest rate expenses annually. In general, our net weighted cost of debt since 2016 decreased by almost 100 basis points, which is like a very high number. Some of it is, of course, the natural decrease in risk-free rates that we experienced and spreads tightening, etc. But it's also like sort of, this being on the ball, taking advantage of how various markets opened in different times with cost advantage, really allowed to benefit from those opportunities. I also have to say that throughout 2020, the Canadian market, home market, was very attractive. This was apparent not only to us, but also to foreign issuers that came to the Canadian market. So altogether, notwithstanding the uncertainties, once like you adopt this proactive approach and sort of look for opportunities ahead of needs, it has been a busy but quite an orderly process, I would say. Right now, where I stand, there is still a great deal of uncertainty, not so much as a year ago, because now we have a track record of the coordinated, determined response from central banks that support the numbers of the markets. But I still would think it's prudent to sort of think very proactively about the financing needs.
Okay. And then Lee, how has Sun Life's financing strategy been in response to those interest rate changes? And what is the company's strategy looking forward to?
Yeah, I guess I would say, similar to what Helena said, I mean, we've never been, we've been in a low interest rate environment for a long time. So it certainly wasn't the low interest rate environment that would cause us to go out and do additional financing or pre-funding. But like Helena said, when the pandemic hit, we really looked at the opportunity to look farther out. So what were those for the next 12 months, what would we want to pre-finance? So we also looked at the market and took advantage of those low rates. So again, did a $1 billion issuance in May of 2020, followed that in 2020 with another $750 million, some of that being pre-financing and some of it just opportunistically taking advantage of the market. And maybe just one thing to add is I think Manulife took advantage of it as well, but the new LRCN instruments that were issued, that gave us an opportunity to look at sort of our capital structure and reduce our capital funding. And we launched an LRCN of $1 billion in June, which allowed us again to save, approximately $9 million a year in financing costs. So a real opportunity to look at our structure. And again, we'll continue to do that as we move forward and manage and monitor the capital markets and the pandemic.
All right. And then just briefly, I know, both your companies have been active in this space, but what we've seen the global green bond market and sustainable financing really move up companies' priority lists. I was just wondering if you could talk a little bit about how your company is approaching the sustainable finance. Let's start with Lee on that one.
Yeah, so obviously we launched our sustainability bond framework now a couple of years ago and issued a sustainable bond right after. I think that's something that continues to be a priority. I mean, for us, ESG is a real focus for our investing portfolio. We've come out and said that we're committed to an additional $20 billion in sustainable investments within 5 years. So that's a huge commitment we've made. Sustainability is a priority for our new CEO, Kevin Strain, has announced that and announced a new chief sustainability officer. So I think, it's certainly something we're going to continue to monitor and manage and look to do that at the right opportunity.
All right. And Helena?
So yeah, we are very keen on the green or sustainable market. You may know that Manulife was the first global life insurance company that issued a green bond in 2017 in Singapore, actually, followed by the second global issue of the green bond in Canada in a sub-debt form. We have like $40 billion of undeniably green assets on our balance sheet already. In terms of renewable energy, we were involved in commercial solar and wind farms since late 1990s because it just made sense for our long-term business and returns. Our real estate is over 80% green certified, etc. And we are the largest institutional timberland manager with managing 5.4 million acres of timberland around the globe. So certainly, and we add to this portfolio in a sort of natural way, $1 billion per year. So certainly a lot of opportunities for green or sustainable financing. We also have investments in education and social housing and similar. We have not issued since 2018, the green bond. And why? I am very hesitant to issue anything against a maturity that's longer than 10 years. The market is changing fast, changing regulations, changing disclosure requirements, reputation risks, measurement, etc. So as such, going longer than 10 years seems a bit sort of extending these risks too much into the future. And to Lee's point, yes, we did issue $2 billion of LRCN in February 21, but because it's a 60-year non-call 5 instrument, we didn't make it green. And similarly with our Formosa bond. I have to say there was an interesting dynamic earlier in the pandemic. We did issue in US senior debt that would be more than suitable to be in a sustainable form, but we refrained from doing so based on the advice from the banks at the time that there was so much uncertainty and volatility in the markets, measured by hours almost, not just days, that issuing in a green format back then would create a one-day delay in terms of marketing and explaining the structure to the investors, and we wouldn't benefit in terms of any break on the issuance costs from this. So we didn't. And I am just amazed how much the market changed since then, how many of insurance companies, but also other companies now have sustainability frameworks in place and came to the markets with sustainable or green financing. So I'm quite sure this advice would be very different today, even in the under the conditions of high market uncertainty. I also have to say, because sometimes I'm asked, like, how about sustainability-linked bonds? And again, like when I look at this whole market, the key risk in some ways is reputation and measurement and disclosure. So to me, like the sustainability-linked bonds add to this risk in the sense that now there is a KPI that the investors and the issuer have to agree how to measure if the investor is to get like a better coupon after a certain time period based on the performance against the commitments of the issuer or not. So to me, it sort of adds to this risk. So for companies like this reputation risk, so for companies like ours who have such big balance sheets and so many assets that clearly fall within the category of sustainable, like just issuing in that format, green format, sustainable format, seems like a good outcome. To take a stand on our support for the sustainability agenda and at the same time to mitigate those reputation and disclosure risks.
Okay, great. Well, that's all the time we have for today. Thank you all for joining us.
Yeah, thank you, Kevin.
Hello and welcome to our Canadian Fixed Income panel. I'm Annie Massa, an investing reporter at Bloomberg News. Joining me today, I have Scott DiMaggio, Senior Vice President and Co-Head of Fixed Income and Director of Global Fixed Income at AllianceBernstein, and David Wolf, Portfolio Manager at Fidelity Investments. Welcome, both of you, and thank you for joining me today. Thanks for being here. I wanted to kick off with a question about inflation. It wouldn't be a fixed income panel without one. I wanted to start by asking about how inflation in Canada, as well as in the US, has been an ongoing concern for investors and for central bankers, presumably. So, looking at Canada's CPI being around 4% year over year, how do you expect Bank of Canada, how long do you expect the Bank of Canada will let the economy kind of run hot like this? And what's your trajectory for that? Can we start maybe with Scott on this?
Yeah, sure. We're very much in the transitory camp. I think that word's been used more in 2021 than it probably has in my financial career. Very much some of the factors that led from the first 3 shutdowns in the Canadian economy, right, around COVID, have very much led to inflationary pressures, mostly on the supply side. We've had some homeowners replacement costs and some of the homeowner components, which continue to move up in CPI. We do think that as we move into the fourth quarter and into the first quarter of next year, that a lot of these factors will start to wane and will start to move lower. I also think as we start to see some of the effects of kind of a fourth lockdown or a fourth wave in Canada, that we will again continue to see some of that downward pressure on the Canadian economy. If you look at the Bank of Canada's forecasts, I mean, they really have things gradually coming down as well into 22, and then really settling at that 2% level over the next couple of years, right into that 2024. And we very much think that's the path inflation will follow.
And anything to add to that, David?
Yeah, absolutely. So first of all, this is what makes a market, because I have basically the opposite view of Scott. So I'm very much in the, I guess we'll call it a persistent camp. I think inflation is going to keep running hotter than both markets and central banks expect for quite some time to come. And I think that's true in Canada and in the US and a number of other countries. When we look at Canada specifically, so as you mentioned, inflation has gone up. It's now running a little over 4%. What's happening, at least in my view, is you have a big mismatch between supply and demand. And there are certain sectors, as Scott mentioned, where you're seeing particular price rises. But in general, in the economy, we see shortages of labor, we see shortages of product. And the restrained growth that we've seen in the economy is not because demand isn't there, because we've created a bunch of money and given it to people. It's because supply is constrained. And supply is constrained not only near term with some of these supply chain issues, but it's constrained longer term as well, at least in my view, with respect to the rearranging of the economy that's gone on in the aftermath of the pandemic, although we're still, I guess, working through that. So as that relates to the Bank of Canada, so the bank's model doesn't work very well in this environment. The model has supply as a function of longer term productivity and labor force growth. And so the bank thinks that there's a lot of capacity, which I don't think there really is. And the facts on the ground of rising prices really show that. And I think the bank knows that its model isn't well suited for this environment, but is reluctant to abandon it. But as inflation keeps going much higher than they expect, which has already been happening for 2 or 3 quarters, I think they'll be forced to look more carefully at, even if growth is not on the strong side, will they have to actually take steps to stop buying bonds and start raising rates?
So we have 2 opposing viewpoints, which makes for a great discussion. A follow-up question for you, David. So assuming that your view of the world is right and we're going to see more inflation carrying forward, how should investors be thinking about that, fixed income investors be thinking about that and positioning accordingly?
Well, I think the primary observation is the market has the Bank of Canada's first hike. I believe it's in the third quarter, September or July. I think it's going to come a lot sooner than that. Exactly when, I don't know. Nobody else does either. As you folks know, I used to be advisor and secretary of the Governing Council of the Bank of Canada, and would often go into a meeting where we talked about the rate decision, not knowing what the rate decision would be. So, if I had access to everything and I still didn't know, there's no way the market can know on any given meeting. But I think it will be much sooner than that July or September. And the consequences, I think, are pretty straightforward from a market point of view. Short end backs off, curve flattens, Canadian dollar goes up, and certain businesses in Canada may have a harder time because of the effects of a tightening on the economy, which in this highly leveraged environment is likely to be pretty significant.
So prepare for maybe seeing a hike more quickly than you would imagine. Scott, in your view of the world where we don't see that kind of runaway inflation and settle into more of a groove, how should investors be positioning for that outcome?
And I like that you picked 2 of us that have opposing views. That's good, because I like hearing David's side of the coin. Yeah, so I'll kind of base our forecast on what the Fed told us just yesterday or a few days ago, in that the Fed tapering will commence sometime in November, December, most likely November. It will end around the July timeframe, and they will set the market up for a late 22, early 23 hike. We think the Bank of Canada is going to follow. So they'll end their QE sometime this year, probably at the end of the year. And we feel that they're not going to go too far ahead of the Fed. So if we kind of put a Fed date out there for January of 23, we would guess the BOC would probably go somewhere in that fourth quarter, as David said, November, December, type of a time frame. The market implications, I think are slightly different. I think rates probably do move higher. Right? We've seen a little bit of that the last couple of days. I think that rates are just kind of too low. Considering that we are commencing a hiking cycle. I think the curve does steepen a bit, and then eventually gets that flattening move that David touches upon. Our primary reason is really around the currency, and that if the BOC does go too early or does a few hikes before the Fed reacts, we are worried that we will see a stronger CAD and the problems that potentially ensue from that to the Canadian economy.
So I want to ask about the U.S. versus Canada here, because in some ways, both central banks are facing a very similar set of problems, containing inflation without spooking the markets too much. I'm wondering if you see the U.S. and Canada diverging on monetary policy and on some of these issues, or do you expect them to follow a similar path? David, why don't we start with you on this one?
Sure, and Scott already touched on this to a degree. First, let me say this is a great renewal of a debate that Scott and I have had for nearly 20 years. So it's nice to be able to do this with the audience. And we don't always see things differently, but it certainly looks like we're at opposite ends of the spectrum right now. So in my view, the paths of Canadian monetary policy and U.S. monetary policy are actually going to be pretty different over the next couple of years. And yes, the bank has to be mindful of the fact that if it gets too far ahead of the Fed, that has impact on the currency. But I don't think they're going to feel like they have any choice with inflation running considerably higher than they would like and then they're expecting. And I think the two biggest reasons why you can get this significant divergence, I'm not talking about the bank raising rates to 4% and the Fed doing nothing, or talking about 50, 75, 100 basis points. Number one, the Fed has, at least implicitly, and this weighs on them, the responsibility for financial markets overall. They know if they shock people, if they taper too soon, if they raise rates, a lot of risk assets in particular are going to have a very hard time. The bank, for better or for worse, doesn't have that burden. So if the bank raises rates, Canadian dollar goes up a little bit, but it doesn't really have ramifications for asset markets the way the Fed raising rates would. So I think that's an important difference. Then the second difference is the Fed has loosened its mandate, as we all know, in terms of incorporating not only price stability, but inclusive growth and such. The bank has not done that. Now, there's a renewal of the inflation targeting agreement coming up later this year, and that is likely to lead to some loosening of the Bank of Canada's objective. But it remains the fact that the Bank of Canada is likely to still be a more sort of doctrinaire inflation targeting central bank than the Fed has become. So in the context of those two things, I think the bank can raise rates considerably sooner than the U.S. is likely to. And I think they're willing to allow a pretty significant divergence between policies in the two countries.
Very interesting. So following two different paths there. Scott, is there anything you want to add?
No, I would just, I think David, the first part hit the nail on the head in that, if the Fed is more aggressive than markets dictate or are expecting, we are going to see the U.S. dollar strengthen. And I think a stronger U.S. dollar is not in anyone's interest. So I think the Fed will drag its feet, our estimation, as long as it can, which gets you into kind of late 22, early 23.
Right. I also want to put us in the direction of one other sign of inflation that people point to in Canada specifically, which is runaway housing prices, with the housing costs rising 30% year over year. Specifically in that realm, are there any particular financial risks that come to the system through such high housing costs and high growth in housing costs? Scott, any thoughts on that?
I feel like David and I have been talking about this in various forms for, probably for 20 years. I think the way we view the Canadian stance is that they're going to try continue with the macroprudential policies as a way to control the flow of credit. Right? If they're not going to worry about the price of credit, via rate hikes, they're going to have to control the flow, right, the supply of that credit. So we already saw in June of this year, a couple months ago, them tighten up some of the minimum mortgage rates for approval, which should lead to a little bit of slowing in some of the approval ratings. We have seen CMHC's share in the market of mortgage insurance declining over the past couple of years. So the government, has been trying to remove itself a little bit, from that part of the market. And, the finance department in Ottawa has been very vocal, it seems like, for the past 10 years, right, about, housing risks and stress tests to the banks, et cetera. So, I feel like we've kind of been here before. I don't think housing really changes the pace of monetary tightening that will occur. I think they will continue to tweak with the macro prudential, measures until they find that right balance.
And David, anything that you would add to that?
Yeah, so maybe let me make a couple of follow-on comments and certainly agree with what Scott said, in particular the notion that housing itself is probably not a big driver of what the Bank of Canada is going to be doing, in the sense that, they're not going to tighten when they weren't going to tighten just because the housing market is strong, and that's been true for some time. One point is just on inflation specifically, as you led off, Annie, with the rise in housing costs and the way that house replacement goes into the CPI, which is a different way of measuring inflation than you have, for example, in the US. The bigger element of housing that's in the CPI that I think is misleading some folks is there's a very big chunk on mortgage interest costs. And mortgage interest costs, certainly is part of the cost of living and should be in the CPI, but should absolutely not be considered as an input into monetary policy because it's a function of monetary policy. And so to illustrate that, interest rate costs in the CPI have gone down about 10% over the last couple of years. That's taking about 0.5 percentage point off of inflation right now. That is not something that should be paid attention to by the bank, because in that world you could say, oh, I have an inflation problem. The way to get rid of it is to cut rates, and then inflation goes down, and then I don't have an inflation problem, which is obviously nonsense. The old core excluded mortgage interest costs for that reason. The new core measures that the bank has do not, which means that I think that if they are relying on those measures that incorporate the mortgage interest cost decline, they're going to be understating what the true rate of inflation is, which is closer to 5 than to 4. The other point I'd make just generally on housing, and as Scott said, we've been dealing with this issue for an awful long time, is I think it will be very interesting to see the impact of even the marginal increase in interest rates on the housing market. Leverage has gone up and up and up. House prices have gone up and up and up, to the point where I think it's reasonable to think that only a small increase in interest rates could have disproportionately large effects on the housing market. That's something that we'll only see after the fact, but it's something that the bank, I think, not only has to risk, but actually might welcome some slowing in that part of the economy and in that market based on an increase in interest rates.
And we just have a couple of minutes left, but I feel I would be remiss if I didn't ask you about the election that we're just coming off of, which many people saw as an election to nowhere, with Justin Trudeau still in power. Just in the last 2 minutes that we have, do you have any thoughts on what investors should take away from that kind of election to nowhere, as some people are calling it? Scott, would you want to start us off on that?
Yeah, I think the trend of more fiscal spending, probably continues. If there is one worry or one camp where, I would agree with David, is that if we can, inflation is going to be a fiscal phenomenon. And if we continue to see these massive fiscal numbers, that could very much hit inflation numbers. I think the two things maybe that maybe investors are not paying attention to is that there's probably two policies that will most likely get passed, right? One of them is going to be a surtax on profits of the banks, right? The largest banks in Canada. So that's going to be, potentially a drain on the dividend distributions that the banks pay out if that gets passed. And we are going to have the higher earners in Canada are going to face a minimum tax under Trudeau, right? And so both of these are going to be revenue raising estimates and probably do hurt the Canadian consumer at the margin.
And David, in our last minute, anything else, any further thoughts on the outcome of this election and what investors should be thinking about it and taking away from it, perhaps on the fiscal side?
Yeah, so to Scott's point, both of those measures will raise revenue, but not anywhere near enough to close the gap. And that was going to be true whether you had a liberal government, a conservative government, majority, minority, what have you. So as it turns out, we have basically the status quo, but all of the parties were essentially continuing or promising to continue the path that we're on, which is very large deficits for a very lengthy period of time. And in that environment, and it's not something we talked about around inflation, but I agree with Scott completely that one of the backdrops that sort of reinforces my view that inflation is going to be concerned for some time is you're going to have these deficits. The Bank of Canada, even if it does tighten up, is going to continue to finance them. Money supply growth has been very large, and that's how you've gotten robust demand in an environment of supply constraint. And Econ 101, lots of demand, not a lot of supply, prices go up, and that's what we're seeing.
Well, thank you both so much for joining me today. Unfortunately, that's all the time we have, but thanks again, Scott and David, for sharing your insights today.
Thanks, Annie.
Thank you.
We are pleased to be joined by Eric Martel, the CEO of Bombardier. Eric, thanks so much for being with us today.
Yeah, good morning. It's a pleasure.
So we, of course, know Bombardier as a giant in the Canadian industrial landscape and a global player in various spaces. And in recent years, as a company in restructuring mode, repositioning, selling certain lines of business. It feels a little bit, Eric, as though you've just achieved a certain milestone. So I wanted to start with where the company is today. For people that think of it as a restructuring play or a repositioning play, what is the new Bombardier?
Yeah. No, as you just said, we went through major restructuring in the last year or so, and we are extremely pleased with where we stand right now, 12 months, 14 months later into this restructuring. Today, we are a pure play business jet company with a very strong focus, with basically 3 business units. One is our global platform, which is well renowned for the flagship of the industry. The Challenger business unit also, which we have competing in the medium market segment in business jet, which has about 2,000 airplanes flying out there, and our services group, which, we are expanding globally across the world.
And of course, through all of that, there have been, new investments made and concerns about your level of debt. Just talk about the balance sheet and where it stands today. How healthy is Bombardier's current balance sheet?
Yeah, our balance sheet has improved quite significantly. Yes, we were very much leveraged a year ago, but with the 3 divestiture that we did last year, we were able to reimburse a major amount of debt. We had many maturities to face in the next 5 years. So today, the next maturity that we will be facing will be December 24. So gives us plenty of time, in the current market, with the investment and the focus that we have to continue to reshape the balance sheet. But today, we're in a very strong and good position. And I think the financial market has been reacting pretty well to our situation. Our stock actually quadrupled since the beginning of the year. And, we look forward. We've made clear objective and commitment to the market for 2025. And we are on a path to deliver those commitments over the next 4 years now.
Eric, of course, the credit markets have been very open in the last year or so, lots of opportunity. Have you been able to take advantage of that to restructure your balance sheet and get the durations of debt that you're looking for?
Yeah, actually, yes. The answer to that is yes. We laid out a plan in early March this year, giving guidance and our commitment, for this year, but obviously also for the next 5 years. And the market has reacted very favorably. So yes, we were able to tap in the market, reduce our debt, reduce the interest also rate that we're paying on the different bonds. So we are extremely pleased to where we are. We have a very much focused right now company, but also, understanding of how we're going to be improving our profitability. As an example, we have the flagship of the industry, the Global 7500, which are learning curve, so improving the productivity is coming down exactly as per plan. We have a very aggressive cost reduction plan, for about $400 million over the next few years. And also the growth of our services business. This is a much more resilient business. We love that business. We are expanding globally that business like we're building right now, capability in Europe, in London. We are quadrupling the space we have here in Florida, quadrupling the space we have in Singapore, and building also in Australia. So we want to reach out to our customer so that they come. We have a plan right now to grow our percentage of revenue from about 18 to 27% in the next 5 years. So we are extremely bullish about that business. We love that business. We have installed base of 5,000 airplanes flying around the world, and we want to tap into this market even more aggressively than today.
And presumably the service business is a smoothing one. In other words, there's a cyclicality to the aerospace industry, to the sale of jets, very tied to the economic fortunes of various countries. So as you grow that business, what's your expectation of how it offsets that volatility and also how it changes the margin picture inside the company?
Yeah. So clearly, you're absolutely right. You know, one of the reasons to grow the services business, it is a much more resilient business in case of an economy downturn around the world. But at the same time, if you understand well Bombardier, there was a strategic mean in keeping the global and challenger business, which is large and medium segment. The large segment has proven to be very, very resilient over the last 20 years. If you go back to 2028, I remember I was around, we delivered like 20% more airplane, you know, with our competitor the following year. So the large segment is resilient, the service business is resilient, and yes, the medium could be a bit more volatile, but it represents 20-25% of our revenue with the challenger. So we have that part, but the rest is very robust to any potential downturn.
One of the, I think, surprising things, and maybe you folks at Bombardier will say you saw it coming all along, but as you got out of, as you really focused on only business jets, you got out of some other very high profile, kind of important industries. We saw this quite amazing shift globally in aerospace to the business jet market. And I don't think anybody would have predicted how much that would happen. And Eric, certainly not during a global pandemic. So is this shift that we're seeing, it's obviously a good one for Bombardier, it plays into your focus. Is it a permanent one? Is this a change in the mix of the market as we look down the road?
Yeah, you know, this is a very fair question, Amanda. And I have to say that in May last year, Bombardier, we thought that this was going to happen, but to be humble here, and we didn't think it was going to happen so fast. So it got accelerated, and clearly, if you go back to 2020, you know, during April and May, there was a lot of nervousness in the market. You know, the commercial aircraft business, all the airlines were grounding their fleet, a lot less flight. So people have started, we've seen a shift during the summer last year in 2020, July, August, of people starting to fly more, the business jet. And I think the first one that I've seen it are the fleet operator, you know, the fractional operator. I'm thinking NetJet, FlexJet, VistaJet, these type of fleet. They've seen an enormous amount of people going their way because they felt that, first of all, there was no available flight, you know, from the commercial world. And at the same time, they felt that it was a safer way to either fly their family or their executive. So we've seen it, a major shift that happened rapidly, faster than we expected. And this keep going since last summer. So this was the first signal of, I would qualify it of a heavy trend of people, you know, going to business jet. And I think we knew that this was going to happen over the years, but it kind of accelerated probably, you know, what could have happened in 10, 12 years over 1 year. Today, if you talk to the fleet operator, they basically have 30 to 40% more people on their list of customers than they had pre-COVID. So clearly there was an acceleration. To your other question, do we believe that this is going to stay? The answer is we believe like the majority will continue to fly on a business jet. There was an understanding that, you know, it's a lot more expensive. I think if you want to fly, you know, premium class all the time with a commercial airline, you realize, yes, it's maybe slightly more expensive, but maybe not that much expensive. And there's different ways. Some people have elected to buy their own jet. So we see also a lot of customers that never purchased a jet before coming to us. Plus, as I mentioned earlier, the fleet operator are seeing tremendous growth right now. And we feel that, you know, that trend is going to stay. Will there be a bit of leakage going back to commercial? Yes, there will be. But we feel that the majority of people that have adopted, you know, the business aircraft world will probably stay with us.
And to that end, you just launched a new jet just a couple weeks ago. What does it represent for you in terms of the market, and what role will it play for you?
Yeah, now this is very important. This is the Challenger 3500 you're talking about, which is an evolution of, you know, a platform that have been extremely successful for us, the Challenger 300, the Challenger 350. So these two programs have been, you know, for the last 15, 20 years, always number one in the market they were competing. You know, despite we're competing with 3 competitors probably, we've been more than 50% of the delivery. So we have a major installed base. The program was still the #1 program. Now we're raising the bar in that market segment with a completely refreshed interior, very stylish. I think it's one of the things that Bombardier has a reputation for is the quality of the interior, the aesthetic of our product, the quality of the craftsmanship. And I think this one, again, is just raising the bar in that market field. So I always think that, we can do a lot of things to improve an airplane, but at the end of the day, the people that are buying the airplane, the majority of the time they sit in the back of the airplane and they want to feel that they're either in their office or that they're at home. So connectivity is important. We have tremendous capability now, which is an improvement to our previous platform. So we feel that, we've raised the bar in that market segment. We're going to be like offering the jet again for the next following years in that market segment, which is extremely popular right now as an entry level for a lot of corporation or even individual.
When we think of the path to sustainability and some of the big commitments that have already been made and might be even, newly made in COP26 in November, we, of course, know that global air travel will be a target. It's a massive source of emissions. Really? Where is sustainability in your thinking, in your innovation, and how do you offset the risk that it represents in terms of higher costs, not just to you, but to your customers?
Yeah, no, fair question. And I always like to say that all our R&D budget today is dedicated to improving gas emission or reducing gas emission, I should say. So we spend, we like to say that we put our money where our mouth is, and this is exactly the example. So the entire R&D budget right now is about reducing emission. How can we have a better shape on the airplane, reduce the aerodynamic, more electrical component, to reduce the weight of the airplane. And we feel that we have some very potential aggressive target we can meet to do that. Plus, on top of it, we're working with the OEM of engine, which are doing also some work there. And plus the sustainable fuel is important. And as an example, this week when we did launch the Challenger 3500, we clearly position ourselves as a leader. We are offering to our customer sustainable material, as an example, material that, are recycled from different fiber or other stuff. So the customer will be able to select also these materials to put on the airplane. So this is really at the forefront of what we're doing and what we're thinking for the future.
Of course, we know there will be a variety of policy options that may be put in place. A price on carbon is one of them, and we see small steps being taken around the world on that front. When you think about the best solution, there must be kind of, I suppose, internal planning or thinking around what would be ideal or the right way to achieve the goal. It's hard to imagine a zero emission plane. Maybe we get there, Eric. But in the meantime, what's the policy path to meeting climate change goals that would best suit your needs?
Yeah. No, you know what? And I think we'll be supportive of any policy change in that regards because we need to do it. So that's why we are trying to be early adapter of new technology. We believe that collectively, I can see a path in 12 years, 15 years from now, where the new airplane going into service could fly with, I don't know, potentially 40% less emission. So that would be clearly a game changer in the industry. More difficult to see a path to zero, to your point, today with the existing technology, but clearly with what the engine OEM are working on right now, ourselves plus the different fuel that we could use on the airplane today, we clearly see a path how to get there. So I guess, I think it's going to be important that, we collectively continue to be aggressive on reducing emission. We know the reason for that. And I think, we'll make sure that our business, remains competitive in that environment.
One of the things that, of course, changed for Bombardier over the past few years has been the ownership structure. You do have government investment in the business. How has that changed your operations in any way? How do you answer to your investors? Are they just one of many, or does it change the tone at all inside? I know you're familiar with government operations, so I wondered actually whether that was an asset to you these days, having been at Hydro-Quebec.
Yeah, no, so you're right. I led Hydro-Quebec for 5 years before coming back to Bombardier last year. But clearly, today we are in a different place. A lot of the investment from the government, are either with the commercial aircraft business that we divest a year ago, like with our previous C series, now the Airbus A220. And today, if you look at Bombardier, we only have, about $250 to $300 million of federal government money, which is basically something we're repaying also, money that we've borrowed, from the government to develop the Global 7500. And this is today the only government money we have. So we have full autonomy in terms of how we're guiding the business for the future and to our plan. So there'll be a time, we'll see, how things evolve. One day we'll need to launch a new program, and we'll have to reassess how we do that to make sure that we remain competitive. But clearly today, there's very little government money within Bombardier as it exists now as a pure play business jet company.
When you think about the path forward, and as you say, you want to grow the service component, and there's lots of good reasons to do that, but it will grow, one imagines, as you get customers around the world. It's kind of a natural outcome. When you think of how you divide your CapEx or your expenditures on the future, how much of it goes into the new planes, attracting new business, and how much of it goes into supporting that growing customer base and, as you say, building actual operations to service business around the world?
Yeah. We are extremely disciplined with our CapEx business. As we committed to the market, we have an envelope for the next 5 years of 200 to 250 million of investment. They could be infrastructure, they could be new program like the 3500, was started last year. We're completing most of it this year, and we're going to be starting to deliver the airplane next year. So a portion of our envelope of 200 to 250 is being used to do that. So a very disciplined approach. We always look at every dollar we invest to say, where do we get the best return? And clearly services stands out as we are investing, as I said, in different part of the world right now with service center. And our strategy is very simple. It's a question of being present. Customer in Asia, as an example, we opened Singapore, 6-7 years ago. We had no presence in Asia. So people don't feel like they want to fly back to North America to get their maintenance done or support. So having that presence as an OEM, basically the customer also prefer to go to the OEM if they are present in the region. So we've seen tremendous growth. As an example, Singapore is one of them. Right now, as I said earlier, we are quadrupling the space in Singapore. So people come to us, we have more jet in service. Again, we have about 5,000 jet in service. Despite that, we're not going to be producing the Learjet anymore. We're going to be serving these 2,000 jet flying all around the world. So this is an important base for us, and we're going to keep going at doing that. So clearly, this is part of our plan. We believe we can have a much bigger portion of our revenue from about 18 to 27% coming from that business. And this is not a business that is capital intensive. This is a business that offers an amazing return, though.
It is, of course, labor intensive, I imagine. How are you on finding the labor you need? It's something we hear from CEOs globally, that it is a tough time right now. Has it been okay for you?
This is I think, a major challenge for all of us. So far we've been able to maintain the rate, keep our supply chain also fairly healthy. But I think as businesses resume, what is going to happen with the other OEM on the commercial aircraft potentially ramping up their capacity. So how will the supply chain resist to that is clearly something we have to work deeply right now. And I think the bottleneck of that will be to attract the right talent, to have the skill. Our industry, aerospace, we need skilled worker. And despite that it's for services, despite that it's for increasing our supply chain capability, we're going to have to face that challenge collectively. But I think, we're working with the different community. This is community by community to make sure that if we have a service center in Fort Lauderdale or in Tucson in Arizona, that we work locally to bring the people we're going to be needing, that we will need in the next 2 to 3 years. So we're trying to be extremely proactive around that.
I have to ask you, it has been a rough few years for Bombardier. You're in a new chapter. Internally, what is the morale? Is there any hangover from, the failure of the C Series, or at least the disappointment of the C Series, or does it feel as though it's a fresh start for this company and its employees?
The employee really feel that we're turning that corner right now. It's been tough, and I think we have to admit that for the employee morale. But I think right now they're starting to see that we are winning and winning more. We'll launch a new program this week. We had 3 amazing quarter. The financial community reacts well to our plans. So the morale is really improving very rapidly internally. So we're happy with that. The employee feel that momentum.
Eric, we appreciate your time today. Thank you so much.
Thank you so much.
Eric Martel is CEO of Bombardier.
Thank you very much. I'm delighted to introduce our next speaker from WSP Global. This is a Montreal-based engineering services company that works across a really wide range of areas. So construction, energy, the environment, mining, telecommunications, transportation, municipal infrastructure. And because of that, I think the company's CEO is well positioned to really give us the lay of the land as we start to look, hopefully, beyond COVID-19 and the pandemic. So without further ado, I'd like to introduce Alexandre L'Heureux, who is the CEO of WSP Global. Thank you very much for making some time for us today.
Thank you for having me.
I want to start with the broadest question, just the economic landscape as we do kind of come through the pandemic in fits and starts. What's most notable to you about the overall environment?
Well, I think no matter where we travel, either virtually or in person, when we can travel, I think that the team and most of the countries where we operate is, a need to stimulate the economy, but also a need to reinvest in infrastructure. So of course, when I look at the trends and I look at essentially the messaging that is going on by most of the developed countries' governments, I think this is obviously looking good for a firm like WSP, where we believe, as you just stated, we are uniquely positioned in the infrastructure space.
I mean, that's certainly true in Canada. Obviously, we've just come through a federal election and infrastructure was at the top of the agenda, near the top of the agenda for the Liberal Party. Within Canada, what is that result likely to mean for you guys?
Oh, well, actually, generally speaking, there is, in my personal opinion, a bipartisan agreement and alignment that infrastructure needs will help restart, if you will, the economy. So obviously, this was good news in some ways, in the sense that we know that the Liberal Party has an infrastructure agenda. So again, looking at the level of proposed activity that is taking place right now in the country is positive. But we are seeing an increased level of proposal activity as well in all of the major hubs where we operate right now. So again, this is again positioning the firm in a very good place for 2022 and beyond.
And I know you said in other markets as well, but I wanted to ask you specifically about the United States and whether or not there's anything in that $3.5 trillion social bill that's sort of addressable to your end market.
Actually, yes. There's a lot of legislation that is being proposed around sustainability, equity, and also sustainability. So these are all sectors where we believe we can make a difference and where we advise many of our clients. So obviously, beyond and above the infrastructure bill, we believe that this proposed legislation will benefit WSP in the longer term.
I want to get back to the sort of ESG green side of things in a second, but just having laid out the landscape for us, so it sounds as though, the market conditions are quite favorable. There's also been obviously a lot written about the really tight labor market for engineers right now. What are you seeing in terms of labor shortages and also potentially wage pressure?
Well, this is not something new. I think the labor market has been tight in recent years. We need to remember that we've had one of the longest boom market in recent history, or certainly over the last 100 years. So before and pre-pandemic, we were already a tight labor market, and this time around is not any different. We need to be creative. We need to have provide career opportunities for professionals to flourish and be in a position to work on the iconic projects, to be able to attract, retain, and reward essentially the best talent in the industry. So obviously the market is tight, and we have seen it not only in the turnover rate in most of the countries where we operate, but at the same time, I'm confident that we have all the tools in our toolbox to be in a position to attract, as I said, the necessary talent to deliver on our backlog. So, but yes, I mean, this is clearly perhaps for a people business like ours, one of the biggest challenge to deliver the work that we need to deliver, which is in some ways good news, unlike the post-recession in 2008, 2009, where essentially the backlog was quite dry. Right now, proposal activity level is quite high, and we are winning more than our share of work. And we just need to be in a position to attract the talent. And in that regard, over the last few months, we have been able to reduce by significantly the number of days, or reduce the number of days between the time when the position is open and when we are able to backfill that position with candidates by approximately 10 days. So that's significant, and we feel that this is already making a difference.
And on the wage pressure side, are you needing to bump up wages in order to do that? Or can you quantify for us in some way sort of the extent of wage pressure that you're seeing?
Well, actually, it would be difficult to answer this question because we are clearly operating in excess of 50 countries, and every country is very different. The dynamic is very different also. So, but generally speaking, yes, we haven't heard or talked about the word inflation in many, many years. And there is clearly, a bit of inflation. But I would also say that this is not the main reason why I believe people are leaving. If people choose to go and try something different, oftentimes it's because we're not providing, the right working environment. And that's why WSP, we're focusing now on providing more autonomy to our professionals, flexibility, agility within the firm, such that we're adjusting to the current market dynamics. So to me, it's not just about money, it's not just about inflation, but it's about providing an environment where we can offer good mentorship to our young professionals and our high potentials, provide a good culture, but clearly provide an exciting working environment. And that's why I believe, and certainly when we survey our employees, compensation comes probably in number 8 or 9 in the list of actions and priorities that we need to focus on.
One more on inflation, and then we'll move on, because I do want to ask you about commodity prices as well and the impact that's having. Obviously, they've been high. How many clients are sort of choosing to wait for those costs to come down, or is it the opposite? They're rushing to lock in prices. How is it playing out?
No, the people are not postponing projects, or our clients are certainly not delaying projects because of the cost of commodities. I mean, they're also aware that there's a crunch right now, and that proposal activity level is up. And that has not been actually a driver for delaying projects. I think inadequate funding, in my personal opinion, certainly in the US, or the fear of having inadequate funding, is perhaps the biggest factor to delay the start of any projects or some of our projects with clients. We haven't seen any cancellation, but we have seen some delays in converting the soft backlog into hard backlog. So I'd say that the commodity price has not been a factor at this point in time. And frankly, it's a cycle, right? And we've seen that in the past, and that has not prevented our clients from putting people to work and making sure that projects are being designed and are being procured and are being delivered, because the needs are there right now, and waiting another 2-3 years just because commodities price are up, I just don't think, for generally speaking, for governments and a politician is a wise way of approaching the infrastructure spend.
What you say about inadequate funding is very interesting to me. Where is sort of the shortfall that your clients are telling you about, and are they coming up with creative solutions? We've written a lot about like green bonds, for example, as one potential sort of funding route.
Well, what I meant by inadequate funding is obviously all the way up to November, nobody was talking about this infrastructure bill, and yet we were clearly forecasting organic growth, and state and municipalities had plans to spend money on infrastructure. But I believe that given the sheer size of the proposed bill, this created a bit of a I wouldn't say concern, but made our clients think a bit harder as to how they should essentially prioritize the spend in their own states, and governors are obviously at the forefront of that. So I think it's been more of a wait and see approach than perhaps inadequate funding. But before prioritizing some of the spend that those states have in mind, they would rather wait and see, how this will be approved and how this will be deployed, and clearly, that's where I believe our clients are the state of their mind at this point in time.
Let's broaden it out again to talk about the scope of the industry to grow. In 10 years, are we going to be seeing sort of the 200,000 person engineering firms, kind of like, PwC, EY kind of model?
I believe so. I think that's what I believe, and I've been saying this for many years now. You look at the accounting industry, and we can no longer call it the accounting industry, given that those big four firms are offering a variety of services that are not necessarily related to accounting, and they have been able to diversify their service offering over time to become large professional consultancies. And you look at the merger of Pricewaterhouse and Coopers Lybrand in 1998 to create a 100,000 people firm. And at the time, people thought that this was the end of it. And you look at PwC today, that is, essentially a firm of, if I'm not mistaken, over 250,000 to 300,000 people after 20 years of uninterrupted growth. I believe that in our space, we are going to see something similar happening. We've seen it in the management consulting world. We have seen it in the accounting world. Law firms slowly but surely are getting on the agenda, and also in the IT consulting world. So I don't see why this would be any different. And we have seen a wave of consolidation over the last decade, and WSP was at the forefront of that. So yes, indeed. I mean, I can pinpoint a number where WSP will be 10 years from now. But I have every confidence, even though it's not an objective to just be bigger for the sake of being bigger, that the WSP should experience a lot of organic and inorganic growth over the next decade.
Well, and in fact, you completed the Golder acquisition this year, which was $1.4 billion Canadian dollar cash deal. How long do you need to wait, I guess, for that acquisition to kind of be fully under your belt before you would consider something else? And just what are the boxes that you need to tick for an acquisition to make sense for WSP?
Well, a lot of good questions into this one. I mean, the reality is, we're never going to be done with integration. And for those of you who've heard me in the past, to me, integration is about leaving and we'll never reach, the port. I mean, at the end of the day, we can always improve our operation. We can always do better. Can always work on our culture. Having said all that, we've made a lot of headways as it relates to this acquisition. The integration is progressing extremely well. We have seen, very low level of turnover, which is typically a very good sign that the firm that we acquired is buying into our vision, is buying into our culture, and is excited by the prospect of combining forces with our existing platform. So I'd say that we are in very good shape. We have an experienced team. We've done many of those in the past. And now we've created the leading firm in earth and environment around the world with 14,000 strong professionals in the space. So we're quite pleased about that. As it relates to the boxes that we need to tick to complete an acquisition, to me it's quite simple. I always look at 4 criteria. The first one is, do we have a strategic imperative to do it? If there are no strategic imperative to do it, why doing it? The second one is the culture right? Do we share the same vision? And typically, if you're not sharing the same culture in a people business or the same vision, this is a recipe for disaster. So even though the price is right and there's a strategic imperative, if the culture is not there, we're not going to do the deal. The third one is quite simple. Is the price right? In merger and acquisition, you can change a lot of things, but there's one thing you're never going to be able to change, which is the price. So you can't get wrong. You can get your price wrong for the asset that you're buying. So is the price right? And the last one is quite simple. You can tick all of the boxes I just mentioned, but if you are unable to integrate the firm for a variety of reasons, you are going to destroy shareholder value. So I need to have the certainty that we have what we need to integrate and combine forces with the target. So if I'm able to check all of those 4 boxes, we're going to look seriously at completing this acquisition. Otherwise, we'll pass. And we are clearly passing way more than we are completing deals. And we remain very disciplined on that.
I want to ask you one about debt as well, which is obviously still pretty cheap. And considering the sort of strong reception of your latest issuance, I'm wondering whether or not you would consider returning to the bond market soon, with or without M&A.
Look, we've always been a fairly conservative management team, meaning that we want to always have a very, very strong balance sheet, because this is how you can be opportunistic in the marketplace and take advantage of our firepower. So we did this raise and we're extremely pleased with it. And I believe that if we were to do more, at this point in time, we need a catalyst, given that we have a very strong balance sheet and very low leverage at this point in time. But who knows? I mean, things change, and perhaps one day we'll decide without an acquisition to go back. But for the time being, I think we have a very strong balance sheet and an optimal capital structure for the time being.
One of the first things you see when you visit your website is your ESG report. Would you consider evolving that into a framework to potentially issue ESG debt?
Look, it's something that we are constantly reviewing, and obviously if we want to be viewed as the leader in the space, in the ESG space, I mean, we need to lead by example. So it's definitely something that we have been looking into and will continue to monitor. for a variety of reasons, given the rules and legislation right now. It's been a bit hard for us to be able to meet the criteria, not so much because of who we are and what we do, but for other specific rules within those green bonds. So, but things change, and again, I would not be all that surprised if the rules are amended for us to be in a position to do that. So clearly, yes, we are monitoring all of the instrument, and if we are in a position to do it, we will do it. I should point out, though, on that note, and just to finish off on this, our syndicate and our credit line has an ESG link component to it. So even though it's not a green bond, we have been able to lead. We are the first professional services firm to complete such a debt raise in North America. So we're quite pleased about that.
All right. I wish we had a little more time, but we're coming right up on 20 minutes, so I'm going to let you go. Thank you very much for your time.
Thank you. Have a good day.
And we are pleased to have with us Pierre-Carl Pelado, the CEO of Quebecor. Thank you so much for being with us today. We appreciate your time. And I do want to start for those who are watching the company. It feels as though there's a new strategic vision in the years ahead. How do you describe to investors what lies before Quebecor? What's your mission right now?
Well, as you know, Amanda, we've been, involved in the telecom business under the convergence model for the last 20 years now, which is, a dramatic repositioning of the company after being involved in conventional media, in printing and pulp and paper. Certainly, the acquisition of Videotron in 2000 changed the trend significantly. It was a conventional cable company, basically servicing, customers, quote unquote, on a monopoly basis, because, cable used to be in that kind of position. The culture that was coming with the monopoly also was forcing us, to change it and making sure that, we will be able to serve the customers first before servicing a subscriber. So since, people had the capacity to change providers, which was not the case previously, then therefore we were forced to change the culture of the company. And we did it. It was also the growth of the internet access, which we were able, to pick up significantly. In fact, our market share was bigger than our competitor. We also launched the wireline telephony, which was also a great success. But early in the process, we thought that cable would probably be, because of the internet, a product that will not have the capacity to grow as it was growing in the past. So therefore, we thought that we would need to move in another direction. We would need to move in a direction where we know that the growth will take place. And then obviously, we thought that the mobile would be this segment of the business that will grow. So then therefore, since there were no such a thing like, a possibility to do so, we negotiated an MVNO contract with Rogers at that time in 2006, and making sure that we will do the proper representation in front of the authorities, the CRTC and the industry minister at that time, to make sure that we will participate in the auction, which will give us the capacity to own spectrum, and to make sure that spectrum will be available for new entrants, then therefore, to have the proper conditions, and those proper conditions will start to be with the set aside. And, I guess that probably did a good job. We were not, the only ones. Other companies were considering also that these conditions will be necessary to make sure that competition will arrive. And then therefore we convinced them, to set aside spectrum in the first AWS. And from there, since, we are facility-based, because the cable business was facility-based, we thought, and we we still consider that there's no room in the future to succeed in the telecom if you're not facility-based. So from 2008 from to today, with all the different auctions and the spectrum that we acquired to be able to move our product within, the technology from 3G, 4G, and now 5G, to make sure that, we will participate in this. And, today we are, I guess, at a certain level with, because, we were the first new entrant that were able, to build that kind of franchise in the mobile business. And today, I guess that since, we're at the level where we know that we will not going to be able to achieve significant growth like the one that we've been able to experience, then therefore we need to consider, doing something else. And for us, doing something else is doing the same thing, but elsewhere.
So then let's be specific, because you did just spend more than $800 million on 5G spectrum. You are being challenged by some of your big rivals about the deal you got on that spectrum auction. And partly the challenge is, do you really exist outside Quebec? Are you saying that your future strategy is to exist as a true rival to those big players right across this country?
Yes. First of all, the 800 also, include the spectrum that we acquire for the portion of Quebec. So then, therefore, if we go outside, is about, a little bit about the same half of it. So it's about 400 million. Am I surprised that, the cartel or the big three would fight against, a fourth operator to come in? I guess, this is all the experience that we've been able to live with, for the last 20 years. This is probably the nature of companies that were able to enjoy a monopoly, to defend them, to take all the proper practices available to make sure that they will fight against this. But, an MVNO and a fourth operator, there's no such a thing like a specific situation in Canada. You'll find MVNO everywhere in the world. You'll find it in the US, you'll find it in UK, you'll find it in France and Italy, elsewhere, and you'll find them also with a disruptive model. And we're far from being original. We don't consider that we're original. We consider, therefore, having the experience in the mobile business, and then therefore having the capacity to succeed. And I really believe that Canadians are looking to have competition, are looking to have something that will be able to change of the incumbents that they've been dealing with for the last 30 years.
So then let's talk about, because this, as you say, you are an integrated play. The company has changed a lot since the acquisition of Videotron. You've just announced a new content platform. I want to call it Cube, but it may not be Cube. I'm going with an English pronunciation. Maybe it is. But where does that fit into the strategy here? Because just expanding it to become, a competitor in wireless is probably not a great profit model. You're going to deliver, no doubt, content and try to gain new subscribers that way.
Well, I guess that, we need to separate, the two things. Obviously, we're in a very mature market in Quebec. I had the capacity to describe it before. We have over almost, 1.5 million customers, and then therefore we also have another equation that we need to deal with, is that what we will do with our media business that we've been operating for the last, 30 or 40 years in Quebec. So then therefore, how can we migrate this on the wireless world to make sure that we will be as opportunistic as possible, and therefore also proposing, what we consider being the best of content in a wireless environment. This is not saying that we didn't make anything before. This is, to conclude that, what we were trying to propose here is a kind of consolidation of the different content that we are producing on a daily basis. from our daily newspapers, from our television, from our cable news, from our music business, from the different things. And obviously, you know, we're quite large in the media landscape in Quebec, and then therefore having the capacity of doing so. Elsewhere in Canada, obviously, it will be completely different. Obviously, we do not have this kind of media, and therefore, you know, the business model that we will use will be different than the one we've been using in Quebec for the last 20 years.
And that business model will be less content driven?
Certainly, you know, at the beginning, it will be, you know, a wireless which will be able, you know, to capitalize on the regulation that exists today, which is promoting MVNO to the condition at the end of the 7 years time frame that you have to build a network. So then therefore, you know, that this is what we intend to do. We have time in front of doing so. Are we going to be able, you know, to replicate different things, or having the capacity to bring, you know, content within this new landscape? You know, this is certainly something that we will have the chance to review down the road, because at the beginning, it will be a pure play in the wireless business.
Meanwhile, the entire landscape could shift with the Rogers-Shaw deal. What's your feeling about whether that deal should go ahead? Do you have objections to it? What would you like to see happen?
You know, we were loud and clear since the beginning. You know, we don't disagree, you know, with the transaction. Certainly, you know, the Shaw family decided, you know, what they were. What they decided, so it's their own right to do so. A natural consolidation would be, you know, we understand obviously that's a large transaction, it's a big transaction, but it's on the same trend that basically all the transaction took place before. So a cable company buying a cable company. Rogers, as Videotron also, you know, are where they are because they've been acquiring cable companies for the last 30 years. And it will certainly, you know, continue to do in the future, since where, you know, I guess that the opportunities are beginning to be, you know, few or quite limited. So is it a natural transaction? You know, I guess certainly yes. The point is that, you know, the wireless business is certainly, and you know, I'm considering that on the Competition Bureau, on the CRTC side, and also on the industry, as you know, this transaction need to be accepted by these three regulatory bodies. And my feeling, but you know, certainly they'll do what they consider being the right thing to do, is if they want to have the large part of the transaction being completed, certainly, you know, Rogers and Shaw should elect, you know, to go through a disposal process for their wireless business. Because my feeling is that, you know, Canadians and the political authorities are looking for a fourth operator. All the experience elsewhere in the world, and also here in Canada, when you compare Quebec prices with the other prices that are taking place in the different other provinces, will show without any doubt that the prices are lower in Quebec because of a fourth operator. And it's not only in Quebec, it's elsewhere in the world. This is probably why, you know, when the T-Mobile and Sprint decided, you know, to merge, first of all, it took a lot of time. And secondly, you know, you've been seeing Sprint or T-Mobile forced to dispose of certain licenses or certain segment of the market to make sure that the fourth operator will have the capacity to live. And basically, you know, this is what we're seeing right now with Dish Network, you know, growing in the wireless business. Yeah. It's true in the US, it should be true in Canada, and it's true elsewhere in Europe, where you have a lot of countries where there are 4 operators involved.
Right. As you embark on this, we should talk about your balance sheet. You definitely have improved it. It's strengthened since the Videotron acquisition. And you've just refinanced some of your debt structure. So you've got some longer term, lower interest maturities. How do you feel about your current position? What might you need to do in the years ahead to finance some of what you're talking about?
It's true, to say, Amanda, that, our balance sheet is it's a very strong. We have, in fact, one of the best, if was not the best, and we'll see, what the auction will end. But before the auction, compared to TELUS and Bell and Rogers, we had a better balance sheet in terms of what we call, the debt-EBITDA ratio. We've been disciplined to make sure that, our CapEx is at a proper level, to make sure, obviously, that we're not going to miss any, significant things that need to be done on the technology side, but also not spoiling our money, and to make sure that, we will dedicate our money in the right place. So the proof of the pudding is the eating, because basically what we're showing in the balance sheet to the marketplace is one of the best. And we will continue to be disciplined to do so. So it's true on the debt EBITDA ratio, but it's true regarding the interest coverage. That is also quite interesting. And you're right to say that we refinance, certain of our debt. Basically, we were coming at the end of it. The deadline was coming, and we were considering that it will be appropriate, to piggyback on the pretty good conditions on the marketplace, on the high yield side. And, today we show up, a proposal in the morning, and it's almost sold by 12 o'clock. Our credibility in the marketplace, for the last 15 years had been strongly and solidly established. And we thank, the market, to recognize, this discipline that we've been able to show for the last decade.
And of course, a lot of that will be dependent on generating solid cash flows. Pierre-Karl, the last years have not been kind to many parts of the media industry. As you know, the model has changed. The advertising base has shifted. Are you confident in your ability to grow those?
This is why, we did the CUM, again, to consolidate all our media and what we consider being the proper distribution platform going ahead, is, the digital economy and the marketplace in terms of advertising will be able, on the digital side, to replace what we used to enjoy in the past. The answer is clearly no. Obviously, the landscape is much bigger, and in front of us is not, the Gazette, is not, the Toronto Star, is not the CBC, is, all those huge international, mostly American companies that are picking, where our advertising market was established before. Does that mean, that we got nowhere else to go than going to the funeral? I would say certainly no. What I'm saying is that, we're going to be able to migrate all this, or we will try to migrate as efficiently as possible. Obviously, there's segment of the population are still, looking for incumbent media, despite the fact that the audience in the broadcasting business has been declining. We still are in a position, to show some huge audience in certain time of the week. The season started back in early September, end of August, and we're showing some 1.3, 1.4, 1.8, or 1.9 million audience, which is far from being the 3 million we used to enjoy, let's say 10 years ago, but it's still significant. And we're going to piggyback, or we're going to try to capitalize on this audience, and making sure also for a younger segment that what we're broadcasting on television is also able to migrate on the digital environment.
That's all we have time for. We so appreciate your time today. Thank you so much.
Thank you, Amanda. Nice talking to you.
Thank you so much to Pierre-Karl Péladeau for joining us today. And we really appreciate your thoughts and the opportunity to hear how you're navigating a very complex environment. We thank also our audience for joining us for the first half of this day. We're going to take a break now. We return at 2 p.m. Eastern Time. We'll hear more great interviews and informative discussions on what's going on in the fixed income capital markets. Take a break, and we'll see you shortly. Thanks.